Please like, share, and subscribe. Wishing you happiness and good luck every day.
We've all seen them, right? The headlines promising incredible investment returns. The ads shouting about the #1 fund of the year. But what if I told you that chasing those hot performers was one of the biggest, most common, and most costly mistakes an investor could possibly make?
You see a headline like this, just blasting last year's big winner. The numbers are huge, the story's exciting, and you feel that little tug, that fear of missing out.
Or maybe you see an ad that just screams, "We're #1." The urge to jump on that bandwagon is, well, it's really powerful. It just clicks in our brain that what has been doing well will keep doing well. It feels like the safest, smartest move you could make. But is following the crowd into last year's winner really a winning strategy? Okay, let's really dive into this. So in this explainer, we're diving into Jack Schwager's classic market sense and nonsense, and we're going to use some hard data to bust one of the biggest myths in investing. We'll look at the lore of winners, ask a really counterintuitive question, follow the data trail, figure out why winners can lose, and then wrap it all up with some smarter insights. All right, let's start by challenging that conventional wisdom head on. Instead of just assuming past success means future success, we're going to ask a really simple but really important question. Does chasing past performance actually work? The book really frames its investigation around these 4 key questions. And to really get to the heart of it, we're going to focus on a big one that a lot of investors try themselves. Does picking the best performing S&P sector from the past few years actually lead to better returns down the road? Okay, now it's time to follow the data trail. We're not going to rely on gut feelings or what's popular. We're just going to look at the evidence, focusing on that strategy of picking the best performing stock market sectors. So the analysis looks at these 10 standard S&P sectors. You can think of them as the big categories of the stock market, like technology or healthcare. You know the drill. The strategy being tested is simple, and it's how a lot of people think about investing. At the start of each year, you put your money into the single sector that was the absolute top performer over the last 3 years. Sounds logical, right?
And this is where it gets absolutely fascinating. Look at the line with the white squares. That's our chase the winner strategy. Over a whole 20-year period, it actually ends up underperforming this simple dashed line, which is just holding an average of all the sectors. And even more shocking, a lot of the time it's lagging behind the solid black line, which is the strategy of investing in the worst performing sectors. It's completely backwards.
So chasing winners gets you lower returns. I mean, that alone is a pretty shocking finding. But hey, maybe you're taking less risk to get those lower returns. Well, let's find out, because returns are only ever half the story. Now, before we see the next chart, it is critical to understand this term, maximum drawdown. This isn't just a little dip. This is the most painful, gut-wrenching loss you would have suffered, from the absolute peak to the very bottom. It's the real measure of risk. It's the "I can't sleep at night" number. And this chart just illustrates the hidden danger perfectly. The prior best sector strategy, that's the white bar on the right, had a maximum drawdown of over 60%. That is nearly double the risk you would have taken by just owning the average of all the sectors. It is a financial roller coaster, and believe me, not the fun kind. Just let that number sink in for a second. To get those mediocre, worse than average returns we saw on the last slide, you had to be willing to watch your investment get cut down by nearly 2/3. This is the very definition of the tyranny of past returns. It lures you in with a promise, and then it punishes you with extreme risk. Okay, so this feels completely backwards, doesn't it? Why do last year's champions so often become this year's laggards? The data is crystal clear, but we need to understand the why behind it all. Well, it's because those extraordinary returns are usually driven by a whole market or sector getting red hot. Think of the dot-com boom. That influence is massive, but it's temporary. It's prone to what's called mean reversion, which is just a fancy way of saying that what goes way up tends to come back down towards the average. True, consistent skill from a manager, that's a much, much smaller factor, and it's incredibly rare. The book uses this brilliant analogy. Chasing a hot track record without understanding why it's hot is like an insurance company giving a policy on a home without even checking its location. Even if that home is sitting in a floodplain, you're ignoring the obvious inherent risk that's staring you right in the face. All right, final section, smarter investing insights. We've seen the trap. Now let's talk about how to avoid it and what this all means for your decisions. Okay, First, let's be absolutely clear about this. The data is not saying you should just blindly go out and buy the worst performing assets. The prior worst strategy also had a ton of volatility. That's just replacing one flawed rule with another. So the crucial point is this. Past returns, by themselves, are a misleading and often counterproductive guide for future results. They are the siren song of investing, luring you towards the rocks of high risk and, ironically, low returns. So let's boil it all down. 1. High return periods are often followed by low return periods. That's mean reversion. 2. Chasing those winners is a trap that often leads to lower returns and much, much higher risk. 3. A fund's amazing performance is usually dominated by the market or the sector, not some lone genius manager. And 4. All of this means you have to look beyond the past return number to understand the real strategy and the risks you're taking on. And that leaves us with a powerful final thought. We've just dismantled one of the most popular shortcuts in investing. So if chasing the rearview mirror is a trap, what should investors be looking for instead? What qualities, what strategies, what principles actually lead to long-term success? That's the real question. So when the market gets turbulent, when everything's in the red and the headlines are just screaming panic, who do you turn to? For millions of us, the answer is the financial experts, right? The charismatic hosts and seasoned analysts on TV projecting this aura of calm and telling us they'll guide us through the chaos. But what if that guidance isn't just unhelpful? What if it's actually making things worse? Let's dive right into this. That searing one-liner, it comes from comedian Jon Stewart, speaking in March of 2009, right in the smoldering crater of the great financial crisis. And look, this wasn't just some late-night joke. It was a full-blown accusation, a shot fired directly at the entire financial media establishment. He was basically saying what millions of people were feeling, that the so-called experts weren't just wrong, they seemed totally clueless while the world economy was in a complete meltdown. And he brought receipts. Stewart unleashed this absolutely brutal montage of disastrously wrong predictions from some of the biggest names out there. We're talking confident assurances that Bear Stearns was solid just 6 days before it collapsed. Bold declarations that Lehman Brothers was strong a mere 3 months before it just vanished. And of course, those relentlessly cheerful calls to buy, 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 while the Dow was literally shedding thousands of points. It was a completely damning piece of television. So here's our game plan for today. We're going to put that accusation to the test. First, we'll start with the comedian's challenge. Then we'll dig into the hard data behind one of TV's most famous financial shows, Mad Money. From there, we'll look at an expert index that was almost never right. We'll analyze the entire industry of paid financial newsletters. And finally, we'll ask the most important question of all. If you can't trust the experts, what are you supposed to do? Okay, so let's get into it. It all kicked off with this simple but pretty profound challenge from a comedian to the entire world of financial media. Now you gotta ask, right? Is this fair? Was this just a cheap shot? I mean, anyone who makes thousands of predictions on live TV is bound to have some spectacular misses. You can't judge an entire industry on just a handful of clips that were edited together for maximum impact. To be fair about it, we have to look at the whole record. So was Stewart just landing a punchline, or did he accidentally pull back the curtain on a fundamental, systemic flaw in the world of financial punditry? To find out, let's start with maybe the most prominent target of Stewart's critique, Jim Cramer and his show, Mad Money. And lucky for us, we don't have to rely on anecdotes or curated clips. Academic researchers have already done the heavy lifting for us, putting his record right under the microscope. So a team of researchers did a super deep dive into nearly 4 years of the show. This covered the boom times and the bust, right up to the very month of Stewart's segment. They meticulously cataloged and analyzed over 1,000 of Cramer's initial buy recommendations to see how they actually performed in the real world. This wasn't about finding a few bad calls. It was about evaluating the entire system. Okay, so check this out. The first thing the researchers found is pretty wild. Cramer did have a noticeable immediate effect on the market. The studies showed that on average, a stock he recommended would jump 2.4% higher than similar stocks the very next morning. This is the famous Cramer bump, basically a rush of viewers scrambling to buy whatever he just touted. But here's the million-dollar question, the one that actually matters for your money. What happens after that initial frenzy dies down? And this is where the story completely flips. If you were lucky enough to already own the stock before Cramer mentioned it, your long-term returns were basically the same as the overall market. Nothing special. But if you were a viewer who heard the tip and bought the stock after the show, catching it after that initial price spike, the results were a disaster. Those stocks went on to underperform the market by a staggering 3 to 10% annually. The creamer bump was a short-term sugar rush that led to a long-term hangover. So the takeaway here is crystal clear. The rigorous academic analysis came to a very simple conclusion. Despite all the entertainment, the lightning rounds, and the sound effects, the average viewer would have made more money by simply investing in a broad, boring market index fund and ignoring the advice completely. Okay, so that's one famous pundit. A big one, sure, but still just one guy. What happens when you combine the wisdom of a whole group of experts? Let's move to our next piece of evidence, a fascinating experiment from the classic TV show Wall Street Week. The show created what they called the Elves Index. The premise was simple and it seemed pretty smart. Each week, they'd survey 10 expert analysts. If they were bullish on the market, they got a +1, bearish, a -1, neutral, a 0. A total score of +5 was a strong buy signal, -5 was a sell signal. It was a formal attempt to capture the consensus of the smartest people in the room. The problem? The expert consensus was almost perfectly, uncannily wrong every single time it mattered. In October 1990, the experts were overwhelmingly bearish, nearly flashing a sell signal, right as the market hit a major bottom and started a massive bull run. In December 1999, at the absolute peak of the dot-com insanity, they were more bullish than ever, giving a strong buy signal just before the whole thing imploded. It reached its all-time high of +9, peak bullishness, as the market was in a catastrophic freefall in early 2000. It's almost comical. And this brings us to the final ironic verdict on the Elves Index. It became so notoriously awful at predicting what the market would do that savvy observers realized its only real value was as a contrarian indicator. In other words, the most profitable strategy was to just wait and see what the 10 experts recommended and then go and do the exact opposite. So far, we've looked at free advice on TV. But what about the experts you actually pay for? You know, we tend to think that if something has a price tag, it must have value. Surely, if you're shelling out a hefty subscription fee for a financial newsletter, that advice has to be worth it, right? Let's widen our investigation one last time. The Hulbert Financial Digest has been the industry watchdog for decades, tracking the performance of hundreds of financial newsletters. And their findings are honestly staggering. Over a 30-year period, from 1981 to 2010, the average paid financial newsletter underperformed a simple S&P 500 index fund by an average of 3.7% every single year. As a group, they consistently failed to beat the market. But hold on, that's just the average, right? A smart investor wouldn't subscribe to just any newsletter. You'd do your homework. You'd find the ones with a proven track record, the all-stars, the top performers from the last few years. That has to be a winning strategy, doesn't it? Well, the data says no. Hulbert looked at this exact strategy. They created a portfolio that each year exclusively followed the advice of the top 10% of newsletters from the previous 3 years. And even this best of the best strategy, a portfolio of the proven winners, still underperformed the market. So the huge takeaway here is that even a history of success, a verifiable multi-year track record of outperformance, wasn't a reliable predictor of future success. The fact that a newsletter did well for 3 years, or even 5, simply wasn't enough to guarantee it would beat a simple index fund going forward. After looking at individual pundits, expert panels, and the entire paid newsletter industry, the evidence seems pretty overwhelming. The pattern is consistent and it is clear. Which brings us to the most important question of all. If the experts can't be trusted to beat the market, what is a regular investor supposed to do with their money? Well, the first step is to confront the core misconception. We believe that listening to experts will give us an edge, some kind of secret advantage. But the reality, backed by all this evidence, is that their advice, on average, fails to beat the market. In fact, it often does worse, which is where you get that old saying that a chimpanzee throwing darts at a stock page would probably do better. The data leaves us with 2 clear and logical paths forward. The first is simple and, for most people, incredibly effective. Accept that beating the market is extraordinarily difficult and instead just aim to match it by buying a low-cost diversified index fund. The second path is for those with the time, the passion, and the motivation to go deeper. Commit the serious energy required to develop, test, and stick to your own unique investment strategy.
And that brings us to this final thought from the legendary trader Michael Marcus. It's such a powerful reminder that in investing, trying to copy someone else's magic formula, even an expert's, is often a recipe for failure. The data we've looked at today suggests that the path to success might not come from listening to others, but from doing the hard work to find your own way.
You know, for the last 50 years or so, there's been this one theory that's pretty much dominated all of modern finance. I mean, it's taught in every business school, it shapes how trillions of dollars are invested. It's called the efficient market hypothesis. But here's the kicker. What if its entire foundation is built on a really simple logical flaw? So here's the big question, right? Can you consistently beat the stock market? Well, the efficient market hypothesis has a very, let's say, blunt answer for you. No. Nope. Can't be done. Anytime you think you've outsmarted the market, it claims, it's just dumb luck. But is that really the whole story? I think we need to take a closer look.
All right, so here's what we're going to do. First, we'll break down this so-called perfect theory. Then we're going to start poking at the cracks in its foundation. We've got some incredible case studies where the whole thing just completely falls apart. After that, we'll tackle the big debate. Is it all just luck, or does skill actually play a role? And finally, we'll look at a more human way of thinking about the market.
Okay, first things first. Let's get a handle on the theory we're actually challenging here. The famous, or maybe infamous, efficient market hypothesis, the EMH for short.
So the core idea is actually pretty simple. The theory says that all known information, everything, is already baked into a stock's price. The moment any new info comes out, boom, the price instantly adjusts. The takeaway? The market price is always the right price, which means there's no way for you to get an edge. And this theory actually comes in 3 different flavors, each one a little more intense than the last. You've got the weak form, which basically says that looking at old price charts is totally useless for predicting the future. Then there's the semi-strong form. This one goes a step further and says, yeah, reading the news, digging through company reports, that won't help you either. And then you have the strong form. This is the most extreme version. It argues that even secret, illegal insider information is somehow already reflected in the price. Kind of wild, right?
So, what's the proof for all this? Well, this is where we hit our first major problem. See, fans of the EMH will point to all these studies showing that most professional investors, the big shot fund managers, don't actually beat the market. And they'll say, see, told you so, proof. But there's a huge logical trap hiding in there.
This is where the logic gets all twisted up. They're confusing cause and effect. Look, it's absolutely true that if the EMH were true, markets would be super hard to beat. But, and this is the important part, just because markets are hard to beat, that doesn't automatically prove the EMH is true. See the difference?
This analogy just makes it crystal clear. It's so simple, but it hits the nail on the head. Just because markets are tough to beat doesn't mean it's because they're efficient. There could be tons of other reasons. And here's the thing about science and logic. You can't use broad evidence like that to prove a theory, but all it takes is one single clear contradiction to disprove it. And as we're about to see, there are plenty of those.
And that brings us right to our first case study. We're going back to the dot-com bubble, to a moment when market prices weren't just a little off, they were mathematically, fundamentally impossible.
Okay, buckle up, because this math is genuinely insane. So, back in 2000, there's a company called 3Com, and they decide to spin off their super hot subsidiary Palm, the Palm Pilot people. At the end of the first day of trading, one share of Palm is worth about $95. Now, here's the crazy part. 3Com still owned most of Palm. In fact, every single share of 3Com stock included 1.5 shares of Palm. So do the math. That's over $142 worth of Palm stock packed inside every 3Com share. But you could buy a share of the parent company 3Com for just $82. The market was literally saying that all of 3Com's other profitable businesses were worth negative $60. It was completely, utterly nonsensical.
So what do you think happened next? Well, exactly what you'd expect when something is that broken. Palm stock completely collapsed. It lost over 99% of its value. This wasn't some efficient price-reflecting all-known information. No way. This was a textbook mathematically provable bubble driven by pure irrational frenzy. The exact kind of thing the EMH says is impossible.
All right, next up, let's look at a different kind of failure. Times when the market had all the information right in front of its face, but just didn't react. Not for months, sometimes for over a year.
Let's take copper, for example.
If you look at the top chart here, you can see that starting in 2002, the amount of copper in storage, the inventories, started to plummet. I mean, a huge sustained drop. That's a classic flashing red signal that supply is getting tight. Now, in a perfectly efficient market, what should the price do? It should shoot up, right? But now look at the bottom chart. The price of copper did, well, nothing. It just sat there flat for more than a year before it finally woke up and took off. The information was totally public, but the market's reaction? It was anything but efficient.
But if you want an even more dramatic example, we've got to talk about the lead-up to the 2008 financial crisis. You remember, the housing market was on fire, but it was being fueled by some incredibly risky lending. And one of the absolute biggest players in that game was a company called Countrywide Financial.
Okay, so the first domino starts to wobble in the spring of 2006. That's when U.S. home prices finally peaked and started to turn down. For a mortgage lender like Countrywide, this should have been a 5-alarm fire. I mean, their entire business model depended on house prices going up forever. But what did its stock price do? Just look at it. It just kept floating around near its all-time high for another entire year.
And then the next warning sign starts flashing. All those people with the super risky subprime mortgages, they started missing their payments. Delinquency rates were climbing steadily all through 2006. Again, this wasn't a secret. It was public information, and it was a direct threat to Countrywide's bottom line. And what did the market do? You guessed it. It completely ignored it.
Finally, those missed payments turned into actual foreclosures, and the numbers just skyrocketed. This was a full-blown disaster happening in plain sight. But it wasn't until the middle of 2007 that the stock price finally seemed to wake up to reality and just utterly collapse. For more than a year, the market wasn't just inefficient, it was completely asleep at the wheel.
So after all that, there's really only one last defense left for the EMH. It's the argument that any investor who wins over the long term is just lucky. That if you have enough people flipping coins, someone's bound to get heads 20 times in a row. But there is one particular track record out there that just blows this "it's all luck" argument completely out of the water.
You've probably heard this one before. It's the classic infinite monkeys argument. The idea is that if you get enough monkeys banging away on typewriters for long enough, one of them will eventually type out the complete works of Shakespeare. And yeah, in theory, that's true. But the real question isn't whether it's possible, it's about how probable it is.
So let me introduce you to the Renaissance Medallion Fund. This thing was run by a team of mathematicians and scientists, and its performance is, well, it's just staggering. For nearly 2 decades, its average monthly return was almost 5%. Think about that. 9 out of every 10 months were profitable. And get this, if you'd invested just $1,000 at the beginning, it would have grown into $35 million. This isn't just beating the market. This is like they're playing a completely different sport on a different planet.
So, what are the odds? What are the chances of a record like this happening by pure random luck in an efficient market? The probability is 1 in 10 to the 48th power. That's a 1 with 48 zeros after it. To put that in perspective, you would need more investors than there are atoms on planet Earth to find just one this good by sheer luck. Let's just be really clear about this. That is not luck. That is skill.
Okay, so when you put all this evidence together, it really points to a completely different conclusion, doesn't it? The market isn't some perfect, cold, logical machine. It's a messy, complex system. And it's driven by us, by human beings, with all of our biases, our emotions, and yeah, our different levels of skill.
You know, the biggest flaw in the whole efficient market hypothesis is this assumption that if everyone has the same information, everyone gets the same outcome. And the game of chess is the perfect way to see why that's just wrong. In chess, both players know all the rules. They can study the same books, look at the same famous games. But does that mean every game is a draw? Of course not. Skill, strategy, psychology, that's what separates a grandmaster from a beginner. Now, the market is infinitely more complex than a game of chess. So why on earth would we assume it's any different?
So where does all this leave us? Well, if the efficient market hypothesis is fundamentally broken, if the market isn't just a random walk, but is actually a complex game of interpretation, psychology, and skill, then that changes everything. It means that opportunities do exist. They exist for people who can see what others miss, for those who can act when everyone else is asleep at the wheel, and for those who can apply genuine skill. Which really just leaves one last, very important question. What's your move?
All right, today we're going to tackle one of the most powerful and honestly, one of the most misleading forces in all of investing: past performance. It seems so simple, so logical to just bet on a winner. But here's the thing. As we're about to see, the past can be a real tyrant, pushing us into decisions that feel so right but might be completely wrong. So, let's break free and look at the hard data.
Okay, so let me ask you a question. Straight up, when you're looking at your options, a stock, a fund, whatever it is, what's the first thing you look at? How do you really decide where to put your hard-earned money? For most of us, the answer is almost a reflex, kind of like a mental shortcut.
Well, the common sense answer, right, is to find something that's been doing really, really well and just jump on board. We see an investment with a great track record, and our brain just lights up and tells us, hey, that's a safe, smart bet. We are literally hardwired to chase success.
And look, this isn't just some theory. The data backs this up in a big way. This chart shows a really powerful and deeply flawed pattern. The dotted line, that's the market's return. The solid line, that's our money flowing in. Just notice how the cash pours in after the market soars, and then it flees in a total panic after it crashes, like in 2002 and again in 2008. We are consistently, and I mean consistently, buying high and selling low.
So this brings us right to the heart of the matter. The powerful, almost magnetic pull of what has already happened. It's an allure that shapes the entire investment landscape, from what you see on TV to your own gut feelings.
Everything about this behavior feels right. It feels so logical. But here's the billion-dollar question that challenges this entire way of thinking. Does chasing those past winners, does it actually work? Does it lead to future success? Well, let's find out.
Okay, to get to the bottom of this, we're not going to mess around with small examples. We're going big. We're looking at the entire U.S. stock market, going all the way back to 1872, to uncover a fundamental secret that runs completely counter to our instincts.
So here's the question we need to answer. If you invest right after the market has had a string of amazing years, how do you do? And on the flip side, what if you invest after it's had a terrible, horrible run? Let's see what the evidence says. And wow. The answer is, well, it's crystal clear. This chart compares the returns you get after the very best periods, those are the light bars, to the returns you get after the very worst periods, the dark bars. Look closely. It doesn't matter if we're looking at 1, 3, or 5-year histories, the pattern is exactly the same. The returns are consistently and significantly higher following the worst periods. Okay, let's just pull out the most shocking number from that chart. If we look at the 5-year data, the average return in the year following the absolute best 5-year runs was 9.4%. But the average return after the absolute worst 5-year runs, a massive 18.7%. That's double. The market delivered twice the return when investors were probably feeling the most scared. All right, so maybe buying the whole market after a good run is a bad idea. I get it. But what if we get a little smarter about it? What if we try to just pick the single best performing sector of the S&P 500 each year? Surely that's got to be a winning strategy, right? Well, let's check the data.
Now, if you just glance at this, you'll see the white line. That's our chase the winner strategy. And you might think, the returns are pretty much the same as just holding the average. But hold on, because that is not the whole story. Not even close.
Yeah, see, so far we've only been looking at one side of the coin, return. And as this great quote from our source material says, that's only half the story. To really understand an investment, you have to flip that coin over and look at risk.
We'll measure risk in 2 simple ways. First, there's volatility. That's basically how bumpy the ride is. Are there wild swings up and down? And then there's maximum drawdown. And folks, this is the big one. This is the number that tells you the most painful loss you would have had to live through from the highest peak to the lowest valley. It's the number that tells you how much it's going to hurt.
Okay, so let's go back to that strategy, but this time let's look at it through the lens of risk. Remember how the returns were almost identical? Well, the risk was not. This chart reveals the hidden cost. On the left, you've got the bumpiness, and on the right, the biggest potential loss. And in both cases, that white bar, our best sector strategy, is just towering over the others. And I really want to zero in on that drawdown number, because this is where it gets crazy. The simple diversified strategy had a max loss of 34%. Look, that's painful, but you can survive it. The strategy of chasing the best sector? It exposed you to a gut-wrenching 65% loss. So even though the final payoff was the same, you got to ask yourself honestly, could you stomach watching your portfolio get cut by nearly 2/3 along the way? Most people couldn't.
Okay, so this strategy doesn't work for the market. It's a disaster for picking sectors,
But what about the pros, right? The smart money. Let's run the exact same test on hedge funds, some of the most sophisticated investment strategies on the planet. And what we find here? It's just mind-blowing, honestly. The white line shows the strategy of chasing the best-performing hedge fund style. The dotted line is the simple average. But look at the black line. That's what happens when you chase the worst-performing style from the prior years. Picking the laggards didn't just win, it absolutely crushed the others. It ended with a value nearly 4 times higher than the best strategy. And just to be clear, this wasn't some one-off fluke. This chart pulls together data across multiple time frames, and the conclusion is undeniable. Chasing the hot hedge fund strategy was a terrible, terrible idea, leaving you with a portfolio worth less than half of what you would have had by just diversifying or, as crazy as it sounds, chasing the losers. And the risk? Oh, the risk was just brutal. The maximum loss for that best strategy was over 60%. The source material calls the gap in risk between chasing the best and chasing the worst an enormous chasm, and you can see why. It wasn't just less profitable, it was dramatically more dangerous. So, let's take a step back and look at what we've just seen. Across the entire market, across individual sectors, and even across the most sophisticated hedge funds on the planet, we've seen the exact same pattern, again and again. Our instincts are leading us completely astray.
So, what are the big takeaways here? Well, first off, chasing winners often sets you up for lower returns down the road. Second, this isn't some isolated thing. We saw it everywhere we looked. And third, and this is so critical, these so-called winning strategies are way, way riskier with the potential for devastating losses. The bottom line is the real story isn't just about return, it's about the return you get for the risk you're forced to take.
And all of this brings us to what we can finally call the tyranny of past returns. It's the way that strong past performance acts like a siren song, luring us in. It makes us feel confident and safe, encouraging us to buy high, often right when an investment has become expensive and super risky. And it does the exact opposite after a crash, scaring us into selling low right when future returns are likely to be at their absolute best.
Okay, so now that we know what this tyranny is, it leads to one last really fascinating question from the source material. We've seen that this happens, but we haven't really touched on why. Why does chasing the leaders so consistently fail? What is it about the market that causes this to happen?
You know, is it just that success attracts a flood of money that creates a bubble? Or is it something else, something deeper about how markets work? The data gives us the what, but the why? Well, that's something worth thinking about. What do you think?
In the world of finance, we're taught to rely on tools to measure risk. But what if the most common tools we use are, well, fundamentally broken? What if they're not just a little off, but are actually actively setting us up for disaster? That's the really dangerous idea we're going to dig into today. And this quote right here, it just nails it. The whole idea is that having a flawed tool can be way more dangerous than having no tool at all. We're not talking about some small miscalculation. We're talking about a basic misunderstanding of risk that can lead to absolutely catastrophic losses.
I mean, think about it like this. If you didn't have a speedometer, you'd probably drive pretty cautiously, right? You'd use your own judgment. But a broken speedometer that's stuck on 50 when you're actually flying along at 90, that gives you this false sense of security. That is the exact problem with so many popular financial risk metrics. They can lull you into a dangerous complacency right before a massive crash.
To really get our heads around this, we're not going to stay in the world of theory. Let's dive into a real-world financial mystery. It's the story of an actual investment fund that we're just going to call Fund X. And on the surface, this thing looked like an absolute dream. Just look at this performance chart. For years, Fund X was the perfect investment. It just climbed and climbed, super steady, delivering an average 12-month return of 79%. And the standard risk models, they loved it. They calculated that there was a 95% chance that investors would, at the absolute worst, still make a 9% gain in any given year. I mean, come on. High returns, low risk, it looked perfect.
But here's where it gets crazy. See that chart on the right? The only difference is one single additional month of data. And with that, the whole picture just completely shattered. That amazing 12-month return plummeted from a positive 89% gain to a devastating 66% loss. All that steady growth, gone, wiped out in an instant. So, this massive collapse brings us to our central question.
the real heart of our investigation today. How on earth could the standard ways we measure risk have gotten it so catastrophically wrong? How did a fund that passed all the conventional safety checks suddenly just drive right off a cliff? To solve this mystery, we've got to bring in our number one suspect. It's the single most common, most widely used measure of risk in all of finance: volatility, which you probably also know as standard deviation.
So what is volatility, really? Put simply, it just measures how much an investment's returns bounce around. Low volatility suggests a nice, smooth, predictable ride. High volatility? That suggests a super bumpy ride with wild swings. For decades, this has been the go-to number for figuring out how risky something is.
And this table here illustrates the idea perfectly. You've got two managers. Both of them average a 15% return. But just look at the range of what could happen. Manager A, with low volatility, is very likely to land somewhere between a 5 and 25% gain, nice and tight. Manager B, on the other hand, whoa, they could deliver a massive 55% gain or a soul-crushing 25% loss. Same average, but a completely different world of uncertainty. And right here, this is the fatal flaw. This is the Achilles heel of using past volatility as our guide. It only works if the future is going to look pretty much exactly like the past. See, Fund X's strategy was to sell options, which is kind of like collecting small, steady payments for insuring other people against a big market disaster. In the calm market of its track record, this was like printing free money. But that calm period, it was never a guarantee of the future.
So the answer to the Fund X mystery isn't just that volatility was a flawed metric. It's that the fund was exposed to a whole class of dangers that simply don't show up on a past performance chart. These are what our source calls hidden risks.
And these are perfect examples. These risks are like crocodiles lurking just beneath a calm surface. They're these event-based risks that just lie dormant when markets are good. They're totally invisible to the standard metrics. But when a storm hits, they surface with a vengeance. And Fund X was a classic case of what's called short volatility risk, a strategy that makes tiny gains when things are calm but faces catastrophic losses when the market suddenly goes haywire.
Okay, let's look at another one, market risk. This chart shows an index of hedge funds in black and the S&P 500 in white. Just notice how closely they move together, right? A fund might have a beautiful track record with low volatility just because the entire stock market was in a steady uptrend. Its hidden dependency on the market, its hidden risk, only shows up when the market finally turns down.
Or take credit risk. That white line represents returns for corporate bond funds. For years, they can look incredibly safe and stable. But the black line shows something called credit spreads. That's the extra interest investors demand to hold risky bonds. When those spreads blow out during a crisis, like they did in 2008, those seemingly safe funds suffer devastating losses.
Okay, so if the track record can be so misleading, what are we supposed to do? How do we protect ourselves? How can we become better risk detectives and spot the hidden dangers of the next Fund X before it blows up? Well, let's look at the toolkit we can use.
Even within the numbers, you can find some really important clues. You can look at a fund's correlation to see if it's just riding the market's wave. You can check out its beta to see exactly how much it moves when the market moves. And this one is my favorite. You can isolate its performance only during down months for the market. This little stress test often reveals weaknesses that are totally hidden by the good times.
But you know, numbers only ever tell half the story. You have to do a qualitative check too. Just look at this table. Let's say Fund A and Fund B have identical track records. Low volatility, small losses. On paper, they look like twins. But when you actually analyze their strategies and score them for these hidden risks, you see a completely different picture. Fund B is a ticking time bomb, just loaded with credit, volatility, and liquidity risk.
So, the crucial point is this. You have to look past the numbers on the page and ask one simple question. Where are these returns actually coming from? Is the manager some kind of genius, or are they just selling insurance against a disaster that just hasn't happened yet? You have to understand the strategy to see the risks that aren't yet visible. The story of Fund X and this whole idea of hidden risks, it really forces us to a fundamental conclusion. We have to completely rethink what risk truly is, and that means busting some of the most common and frankly dangerous misconceptions in the investing world. First and foremost is this myth that low volatility equals low risk. As we've seen, this is probably the most dangerous myth of all. Low volatility can simply mean that a strategy has been lucky. It's been operating in a nice, calm environment where its key weakness just hasn't been tested. Second, we have to stop judging future risk by past losses. That's literally like trying to drive a car by looking only in the rearview mirror. The biggest dangers are often the ones you haven't seen yet. The most catastrophic risks are, by their very nature, rare events.
And finally, even a really sophisticated-sounding metric like value at risk or VAR, it falls into the exact same trap. VAR is supposed to tell you the most you can expect to lose, but because it's built on data from normal times, it's like an airbag that works perfectly in a fender bender but fails to deploy in a head-on collision. It is unreliable precisely when you need it the most.
If there is one single lesson to take away from all of this, let it be this. A clean track record is not proof that a strategy is safe. Our source uses a perfect analogy. A house built in a floodplain is risky, even if it hasn't flooded in the 5 years since it was built. Just because the disaster hasn't happened yet doesn't mean the risk isn't there.
We'll end with this piece of ancient wisdom, which is just a perfect metaphor for investing. It's such a powerful reminder that the biggest, most dangerous risks are often the ones lurking silently, invisibly, just beneath a deceptively calm surface.
You know, we're always told to fear volatility in the market, but what if the real danger isn't just about a bumpy ride? What if there's a hidden mathematical trap that's just silently eating away at your returns? Today, we are going to pull back the curtain on this exact flaw by looking at one of the most popular and honestly most misunderstood products out there, the leveraged ETF.
I mean, it's the ultimate sales pitch, isn't it? The market goes up 5%, you make 10%. Simple, powerful. That is the promise of a 2x leveraged ETF. It's an idea that just sounds almost too good to be true for anyone looking for that extra edge. But what if that simple promise is actually a carefully disguised mathematical trap? Okay, let's jump right into the real world. Between 2007 and 2011, the S&P 500 had a really wild ride and ended up down about 4%. So basic math tells you a 2x leveraged ETF should have lost twice that, right? So around 8%. But the actual result for a very popular 2x S&P 500 ETF was a staggering 41% loss. How on earth is that possible? I mean, this isn't a rounding error. It's a financial black hole. And understanding why this happens is one of the most critical lessons in modern investing. Well, the answer to that huge mystery lies in a concept that most investors just completely miss. Volatility itself, just the simple up and down movement of the market, it acts like a hidden tax on your portfolio. It's not just about the psychological stress of the swings. The bumpiness itself mathematically grinds down your returns over time. Let's break down how that works. This slide shows a scenario that seems ridiculously simple. Imagine you invest $100. Year one is a blockbuster. You're up 50%. You've now got $150. Awesome. But then, in year two, the market turns and you lose 50%. You'd think, okay, a 50% gain and a 50% loss, they should cancel out, right? I'm back at 100. But that's not what happens at all. You're actually down 25%. See, that 50% loss wasn't on your original $100. It was on your new higher balance of $150. So you lost $75. You're left with just $75. And here's the key takeaway. A symmetric percentage gain and loss always ends up as a net loss. This is that hidden tax of volatility, right there in action. And this effect, it has a name. It's called volatility drag. It's this quiet, relentless mathematical force that just erodes your compounded returns simply because prices are fluctuating. And the wilder the swings, the higher the volatility, the more powerful this drag becomes, no matter what the average return might look like on paper. And this table just brilliantly illustrates the destructive power of that drag. Just look at this. In every single one of these cases, the average monthly return is exactly the same, a positive 1%. But now, look at that column on the far right, the actual 12-month compounded return. As the volatility, those monthly swings in the middle, gets bigger and bigger, the real-world return just collapses from a healthy 12.4% gain to a shocking 9.2% loss. Same average return, totally different and devastating outcomes. So how does all this connect back to our mystery of the self-destructing ETF? Well, these leverage products have a very specific core mechanism that takes this principle of volatility drag and actually weaponizes it. It's called daily rebalancing. And it's how a promise that works perfectly for a single day becomes a catastrophic problem over the long term. So here's the process. The fund promises to deliver double the market's return for that day only. To keep that promise, the fund manager has to reset the leverage back to 2x at the end of every single trading day. This means if the market goes up, they are forced to buy more assets at a higher price. If the market goes down, they are forced to sell assets at a lower price. This constant buying high and selling low is the absolute key to the entire trap. Now, to be fair, there is one environment where this works beautifully. In a strongly trending market where prices just keep going up and up, this daily rebalancing acts like a turbocharger. A 10% gain followed by another 10% gain in the market compounds to a 21% return. But for the 2x ETF, the 20% gain on day one is followed by another 20% gain on that new, larger capital base. It compounds magnificently, turning into a 44% return, more than double the market's gain. But let's be real, markets don't always trend. What happens when they get choppy, when they go back and forth? This is where the trap springs shut. A 10% gain followed by a 10% loss leaves the market almost flat, down just 1%. But for our 2x ETF, it's a 20% gain followed by a 20% loss. And as we just saw, that results in a much bigger 4% loss. The daily rebalancing is forcing the fund to do the exact opposite of what you'd ever want to do: buy high and sell low, day after day. Okay, so now that we understand the hidden mechanics of volatility drag and daily rebalancing, let's go back to our original mystery: the disastrous performance of these leveraged ETFs between 2007 and 2011. And now it's all going to make perfect sense. And here it is again, the 2x long ETFs. That's the line with the white circles. You can just see how it plummeted over this choppy period, losing a devastating 41%. It was simply bled dry by volatility drag. Meanwhile, a simple strategy of just getting 2x leverage on margin without any daily rebalancing would have only lost 4%. The difference is just breathtaking. But here's where it gets truly bizarre. You would assume that in a market that ended up down, a 2x times short ETF, a product literally designed to profit from market declines, would have been a huge winner. But look at this. The ultra-short ETF actually lost 58% of its value. The very thing that was supposed to protect you in a down market was destroyed even more viciously by volatility. And now for the final unbelievable twist. What if you tried to be market neutral? You buy both the 2x long ETF and the 2x short ETF, thinking, hey, I'm covered no matter which way the market goes. Well, that strategy was the most catastrophic of all. By holding both, you were just paying that volatility tax to two different masters, resulting in a near total loss of 99%. Let's put this in stark dollar terms. A $10,000 investment in the 2x long ETF lost over $4,000. That same $10,000 in the 2x short ETF lost even more, $5,800. And our market neutral strategy, putting $10,000 in each, would have vaporized nearly your entire $20,000 investment. It's a structural failure, plain and simple. So the crucial point here is that while these products might have a tiny niche use for some hyper-aggressive day traders, they are fundamentally broken for any investor with a time horizon longer than a single day. But what if you still want leveraged exposure to the market? Fortunately, there are much smarter and much safer ways to do it. The conclusion from the research is direct. It's unambiguous. For anyone holding a position for more than a day or two, these products should just be avoided. The built-in headwind from volatility drag is a losing battle over the long term, period. So what are the better options? Well, first, you could simply buy twice as much of a standard unleveraged ETF using a margin account. This gives you that 2x exposure without the destructive daily rebalancing. Second, you can use futures contracts, which are the tool professionals use for efficient leverage. And finally, you can buy deep in-the-money call options. They track the underlying asset very closely, giving you leverage without those corrosive effects of volatility drag. And that brings us to our final thought. The cautionary tale of the leveraged ETF is such a powerful reminder that complexity often hides in plain sight. It really, really pays to look under the hood. So the question is, what other products, advertised as simple solutions, might be hiding a dangerous mathematical trap just waiting for an unsuspecting investor? Something to think about.
Okay, so when you're sizing up a new investment, what's the very first thing you check? Come on, be honest. For almost all of us, it's the track record, right? That history of performance. But what if relying on that record is actually one of the biggest traps in all of investing? Well, stick around because we are going to dive into the hidden pitfalls of track records and, more importantly, how you can learn to see what's really going on behind the numbers.
Ah, yeah. Just look at that. It's the chart every single one of us dreams of finding. That beautiful, smooth, steady climb upwards. It looks like a straight-A report card. It just screams safety, reliability, and, most of all, profit. This thing is the holy grail, and boy, is it tough to resist.
But here's the catch, and trust me, it is a big one. That gorgeous, soaring chart, it can be hiding a whole lot of problems. It might not be telling you the full story at all. In fact, some of the absolute best-looking track records are secretly the most dangerous. So right now, we're going to pull back that curtain and see what's really happening. So here's our game plan. We're going to tackle 4 huge myths about investing. First, we'll see exactly when history turns into a trap. Then, we're going to figure out how to separate real skill from just pure dumb luck. After that, we are untangling the very tricky business of comparing different funds. And finally, we'll dig into this weird paradox of why a longer record isn't always a stronger one. By the end of this, you're going to have a brand new toolkit. Ready? Let's do it.
First up, the data relevance pitfall. This one sounds a little technical, but it's super simple. It's the trap of just assuming that whatever worked in the past is going to automatically keep working in the future. It's a really easy mistake to make, but wow, the consequences can be massive.
Let's start with a classic case. Take a look at this 30-year chart for Treasury bonds. For 3 entire decades, this was one of the best investments you could possibly own. An incredible, sustained climb. Now, if you based your decision only on this track record, you'd be putting all your money into bonds, no question.
But here's exactly why that history is a trap. That whole 30-year party was driven by one single thing: falling interest rates. Rates plunged from around 15% all the way down to 3%. Now think about it. For that amazing track record to repeat itself, rates would have to fall another 15%, from 3% all the way down to negative 12%. That's not just unlikely, it's basically impossible. The conditions that created that past success simply cannot happen again. And that brings us to our first huge takeaway. The idea that you can just bank on past returns is a total myth if the world has fundamentally changed. In the case of bonds, the past isn't just a poor guide for the future, it's an impossible one. So the first question you always have to ask yourself is this history even relevant anymore?
So what about when the past does seem relevant?
Well, that leads us to our next big pitfall. We see a fund with these amazing returns and our brain immediately goes, wow, this manager's a genius. But you gotta pause and ask, is it really skill? Or is it just luck? Or even worse, is it a huge hidden risk that just hasn't blown up yet? The dot-com bubble is the absolute perfect example. Back in '98 and '99, the managers who were posting these unbelievable returns were the ones making the absolute riskiest bets. They just loaded up on speculative internet stocks. And you know what? The market rewarded them for it. The crazier the risk, the better the performance. Then March 2000 hit. The bubble popped, and guess what happened? Those same star managers became the absolute worst performers as their portfolios completely imploded. You know, this perfectly illustrates that old saying, never confuse brilliance with a bull market. A rising tide lifts all the boats, right? Even the leaky ones. It's so easy to look like a genius when everything's going up, but that doesn't mean you are one. And we saw the exact same pattern play out in the credit markets leading up to the 2008 crisis. The funds with the best results were often the ones using the most borrowed money, the most leverage, and taking on the most credit risk. That risk was totally invisible while the market was calm. But the second things turned sour, those high-flying funds suffered massive, leverage-magnified losses.
So this just shatters another really common myth, the idea that high past returns are always a good thing. Sometimes they're actually a giant red flag that someone's taking on way too much risk. The reality is you have to look past the number and really understand its source. Was it skill, or was it just a crazy bet that happened to pay off in a friendly market?
Okay, so let's say we found a fund where the past performance seems relevant, and it actually looks like it came from skill, not just risk. Great, now we have to compare it to other funds, which leads us straight into our third trap, the classic apples to oranges pitfall.
All right, quick pop quiz for you. Fund A has had a maximum loss, or what we call a drawdown, of 25%. Fund B's worst loss was only 10%. So which fund is the riskier one? Seems pretty obvious, doesn't it? It's got to be Fund A. Or does it?
Whoa, not so fast. We were missing a really crucial piece of information: time. See, Fund A has been around for 7 years, while Fund B has only been around for 3. That's not a fair fight. But check out what happens when we compare them over the same 3-year period. Fund A's max loss was just 5%, while Fund B's was 10%. All of a sudden, Fund A looks less risky. Context completely changes the picture.
So to make a fair comparison, you have to be really rigorous. You can only compare funds over the exact same overlapping time period. They also need to have a similar strategy. You can't compare a stock fund to a bond fund. And they really should be trading in similar markets. A commodities trader and a currency trader are playing 2 totally different games.
And that busts another really dangerous myth. Looking at performance since inception can be incredibly misleading. The reality is simple. A comparison is only meaningful if you are truly comparing apples to apples. Same time period, same strategy, and same markets. Period.
This brings us to our final, and maybe our most surprising, pitfall. It's what I call the paradox of time, and it challenges one of our most deeply held beliefs about track records. I mean, come on, it's just common sense, isn't it? A 20-year track record has to be more reliable, more meaningful than a 3-year track record. There's way more data, more history, it's been through more market ups and downs, it just has to be better, right?
Well, get ready to have your intuition flipped upside down. A longer record can actually be less relevant, and here are 3 key reasons why. First, the strategy changes. A successful manager gets a flood of new money, which can force them to invest differently. The small, nimble strategy that built that amazing record might be impossible to pull off when you're managing billions. Second, the strategy's edge might have just disappeared. What worked great 15 years ago might not work today because markets changed or everyone copied it. And third, and this is a big one, the manager might have changed. That star who built that incredible early record, they might have retired or left years ago, meaning you're actually investing with a totally different person.
So our final myth to bite the dust is this idea that longer is always better. The reality is, a long track record is pretty much meaningless if the fund today is fundamentally different from the one that created that record. Sometimes the most recent history is the only history that truly matters.
Whew! So after navigating all those pitfalls, what does this all mean for you? Well, it means it's time to upgrade your toolkit. It's not about ignoring track records entirely, but it's about asking way smarter questions.
Look, if you only take one single thing away from all of this, let it be this. You have got to go beyond the simple numbers on the page. You have to understand the source of the past returns. Was it a repeatable skill or a one-time market fluke? And you absolutely must understand the risks that were taken to get those returns. Was it smart investing or was it a reckless gamble that just happened to pay off this time?
In the end, looking at a track record is kind of like looking at a mountain climber who's standing on the summit. It's impressive for sure. But before you trust them to be your guide, you need to ask one simple, powerful question. How did you get there? The answer to that question, well, that tells you everything you really need to know.
Hello and welcome. Today, we're going to unpack a financial term that can be incredibly helpful or incredibly deceptive, and that term is pro forma. You see, it gets used in 2 completely opposite ways. One is totally above board, the other is, well, pretty misleading. Knowing how to tell the difference is absolutely crucial, so let's get right into it. So, let's start with a bit of a brain teaser. What if I told you that a hypothetical number, a number that's technically made up, could actually be more honest than a real, actual number? It sounds completely backwards, right? But stick with me, because by the end of this, you'll see how that can happen and why it's such a big deal for any investor.
Here's our game plan for today. We'll start with the pro forma paradox itself. Then we'll expose something called the hindsight trap. After that, we'll look at when a fake number is actually more real. I'll give you a simple 2-question toolkit to take with you, and we'll finish up with the ultimate litmus test to sort the sense from the nonsense.
All right, so let's jump right into this paradox. The whole reason the term pro forma is so tricky is because it can be used for good or for evil, so to speak. It can either make things way clearer or it can be used to seriously pull the wool over your eyes. So, what are we really talking about? Well, at its core, pro forma results are just hypotheticals.
Think of them as what-if scenarios. They pop up when the real, historical numbers don't exist, or, and this is the important part, when those real numbers don't actually tell you the full, honest story. The key thing to remember is that the adjustments they make can be either super insightful or dangerously deceptive. To really get this, we've got to look at the dark side first. This is what we call the hindsight trap. It's where pro forma gets its bad reputation, and the main villain in this story is a bias we all have, the power of hindsight. Okay, so imagine this. A manager is launching a brand new fund of funds. They don't have a track record yet, so they create a pro forma one. They show you this perfectly curated portfolio, and they say, hey, if you had invested in this exact mix of funds 5 years ago, you would have made a killing. And when you look at the chart, it looks absolutely amazing, a total no-brainer. And what makes it so convincing is that the numbers for each of those individual funds are real. It's actual historical data. But here's the trick, right? The manager is picking those funds today, knowing perfectly well which ones were the rock stars of the last 5 years. They're basically building a fantasy portfolio that was guaranteed to win because they already know the outcome. That's the hindsight trap, and it makes these numbers completely useless for predicting what's going to happen next. Here's another classic trap you might see. Let's say a manager has a big diversified portfolio, and they notice that their tech stocks have just gone through the roof. So they get an idea. I'll launch a new, specialized tech fund. To market it, they create a pro forma track record showing how that one slice of their bigger portfolio has performed. So, again, the numbers are technically real returns, but the selection process is an illusion. You know, in any big portfolio, some part of it is always going to be doing better than the rest. That's just how it works. By carving out only the winning segment after it has already won, the manager is painting a beautiful but totally misleading picture. It's the definition of cherry picking, and it's all powered by hindsight. Okay, so at this point, you're probably thinking that pro forma is just a fancy way of saying scam. And look, it's really tempting to just decide, all right, I'm just going to ignore these numbers completely whenever I see them. But that would also be a mistake, because there's a whole other side to the story. And that brings us to the sense part of the equation. Because believe it or not, sometimes a hypothetical fake number isn't just okay to use, it's actually way more meaningful and more honest than the actual results would be. Let's look at a completely different scenario. You have a manager who's been running a strategy with their own money, and they've had fantastic results. Now, since it was just their own private account, they obviously weren't charging themselves any management fees. But now they want to open that same strategy up to the public in a new fund, which of course will have fees. Now, think about it. If that manager showed you their actual historical returns, they'd be misleading you. Those numbers are inflated because they don't account for the fees that you, as a new investor, are going to have to pay. So the most honest, transparent thing they can do is create a pro forma result by taking their old returns and subtracting the fees. In this case, that fake, adjusted number is a much more real and representative picture of what you might experience. There is zero hindsight involved here. It's just a simple, fair adjustment. So, we've got the deceptive use, and we've got the legitimate use. How in the world do you tell them apart? Well, it actually comes down to a really simple 2-question toolkit you can pull out anytime you see the words pro forma. Here they are. Question number 1, and this is the big one. Does this result use hindsight? Was a perfect portfolio built using past winners? Was a top-performing sector cherry-picked out of a bigger pile? If the answer is yes, that's a huge red flag. Then, question 2, is this hypothetical result more representative of what my experience might be than the actual numbers? Think back to our fee adjustment example. If you get a no to hindsight and a yes to being more representative, then you're almost certainly looking at a legitimate, honest use of pro forma. All right, let's bring it all home with the ultimate litmus test. This is what's going to help you cut through the 2 big mistakes people usually make when they come across pro forma numbers. You see, people tend to fall into one of 2 traps. The first trap is being way too trusting and just assuming that these hypothetical numbers are a pretty good guess of what's going to happen. The second trap is being way too cynical and just assuming they're always a lie and should be ignored completely. And as we've just seen, both of those views are flat out wrong. The reality is that it all comes down to one single thing, the ultimate test, the one factor that separates the good from the bad, the sense from the nonsense, is this. Was hindsight involved in creating this number? That one question, right there, makes all the difference in the world. So now you've got the toolkit, you know about the danger of the hindsight trap, but you also know the value of an honest adjustment. So the next time you see the words pro forma in a report, you're not going to be confused. You're going to know exactly what to ask. Thanks for watching. Welcome to the Explainer. Today, we're going to talk about the single most common number in investing, the headline return. And we're going to show you why, on its own, it's pretty much useless. By the end of this, we're going to build a totally new framework so you can see performance the way the pros do. All right, let's kick things off with a quick puzzle. You're booking a hotel room online. Same room, two different websites. Site A says 320, Site B says 250. So, which one do you pick? It's a no-brainer, right? Site B is obviously the better deal. Or is it? And boom, just like that, the answer completely flips when you add one tiny piece of context, the currency. What if Site A is 320 US dollars, but Site B is 250 British pounds? Well, all of a sudden, that $320 price is a way, way better deal. See, the numbers themselves didn't mean anything without knowing their denomination. And that right there is the key to everything we're talking about today. Because in the world of investing, people make this exact same mistake constantly. They compare returns without looking at the currency. And in our world, risk is the denomination of return.
Okay, so here's the game plan. First, we're going to prove why looking at return all by itself is just a recipe for disaster. Then we're going to put the industry's favorite tool, the Sharpe ratio, under the microscope and show you its hidden flaws. After that, we'll build a much better toolkit and even stage a manager showdown to see these new tools in action. We'll also see how our own eyes can be our best or worst analytical tool. And then we'll wrap it all up into a new framework you can start using right away. So first things first, let's really dig in and bust the biggest myth in investing, this idea of just chasing the highest return. Take a look at these two managers. Manager A gives you a 10% return with a risk level of 5. Manager B gets you 25%, but with a risk level of 25. Now, your gut instinct, like most people's, might be to go for Manager B. You think, yeah, I'll take on that extra risk for that much more return. But that whole way of thinking is just wrong. It assumes you're stuck with the risk level you're given. But check this out. What if we could just tweak the settings a bit? Let's say we take Manager A's strategy and just apply a little leverage, basically borrowing to invest more. If we apply 3x leverage, look what happens. Our return jumps to 30%, which is higher than Manager B's. And our risk? It only goes up to 15, which is still way, way lower than Manager B's. We're getting more return for less risk.
And this is the whole point, right here. Manager A is just fundamentally a better investment, period. Even if you love risk. That superior return to risk ratio gives you choices. You can dial it up and beat Manager B at their own game. So that headline return number, it's basically noise. What really truly matters is the return you get for each unit of risk you take. Okay, so if the ratio is what matters, how do we measure it? Well, the industry's go-to tool is something called the Sharpe ratio. But, and this is a big but, it's got some serious problems that can lead you completely astray. You see the Sharpe ratio everywhere. It's on every fund's fact sheet. And all it is, really, is your return over some risk-free rate divided by how much your returns bounce around, the volatility. On paper, it sounds pretty smart, right? Return divided by risk. But this simple little formula has a couple of massive hidden trapdoors. And here they are. Problem 1, it uses average return. Let's say you're up 50% one year and down 50% the next. The average is 0, but you didn't break even, did you? No way. You actually lost 25% of your money. The Sharpe ratio completely misses the effect of compounding. Problem 2 is even crazier. It punishes all volatility. Think about it. Have you ever complained because your portfolio went up too much in 1 month? Of course not. But the Sharpe ratio sees a huge win as just as risky as a huge loss. It's nuts. Okay, let's put this to the test. Forget the math for a second, just look at these two charts. Manager A and Manager B end up with the exact same final return. But just using your gut, which one looks like a scarier, riskier ride to you? It's gotta be Manager A with those massive stomach-churning drops, right? And yet, look what the Sharpe ratio tells us. It says Manager A is the better risk-adjusted performer. Why on earth would it do that? Because Manager B had some really big up months. That good volatility gets punished and the whole result gets skewed. It's a perfect example of a number that's mathematically right, but practically useless. Clearly, the Sharpe ratio isn't cutting it. We need a better toolkit. So let's bring in some smarter ways to measure this stuff, some alternatives that actually reflect an investor's real experience. So first up to bat is the Sortino ratio. You can think of it as a much smarter cousin of the Sharpe, designed specifically to fix those two huge problems we just talked about. So what makes it so much better? Well, for starters, it uses the compounded return. You know, the actual return that shows up in your account. And second, it only looks at downside risk. It completely ignores those big up months that we all love. It focuses only on the volatility that actually hurts. All right, next up we've got something called the gain to pain ratio. And honestly, the name kind of says it all. This one is super intuitive and gives you a really practical way of looking at performance. Yeah, this really gets to the core of it. You just add up all the returns from your winning months, and you divide it by the sum of all the losses from your losing months. It asks a really simple, powerful question. For all the pain I had to go through, how much gain did I actually get? If the number's over 1, your gains were bigger than your pains. Simple as that. Okay, tool belts loaded up. Let's go back to our two managers from before, the ones that the Sharpe ratio got so completely wrong. Let's run the numbers again, but this time with our smarter toolkit. And wow, look at this. The results are just stunning. The Sharpe ratio is literally the only one on this entire list that picks manager A. Every other more sophisticated measure says manager B is better. Our new friend the Sortino ratio prefers B. The gain to pain ratio gives a slight edge to B. And then look at the metrics that focus on the really deep losses, the tail ratio and the MAR ratio. They say manager B is over 2.5 times better. The verdict is just overwhelming. So the numbers are pretty clear, but sometimes just using your eyes can tell you more than any spreadsheet. That said, you have to know how to look, because charts can trick you just as easily as statistics can. So you look at this chart, and what's the story it's telling you? It looks like things are getting crazier and crazier toward the end, right? The gains are bigger, the drops are bigger, the whole thing just looks like it's accelerating. Well, I'm here to tell you that chart is lying to you.
Now, this is the exact same manager, the exact same performance data. The only thing we've done is flip the switch on the chart to a logarithmic scale. A log scale shows percentage changes equally, and suddenly, you see the truth. The pattern of returns was the same the whole way through. A 10% drop looks just as big at the beginning as it does at the end. For really understanding performance, you have to use a log scale chart. Okay, let's pull all of this together. We've torn down the old way of thinking, so let's build your new, smarter framework for looking at any investment, starting right now. So here is your 4-step cheat sheet. 1. Never, ever look at a return number by itself. Remember the hotel prices. Risk is the context. 2. Be super skeptical of the Sharpe ratio. It punishes good news. 3. Use better tools. The Sortino or the gain to pain will give you a much better feel for the real story. And 4, trust your eyes, but make sure you're looking at a log scale chart. It's probably the most honest tool you have.
So this isn't just theory, right? You have a portfolio, you have a 401k, you're looking at mutual funds. You now have a concrete, superior set of tools to go and look at all of it in a much smarter way. Instead of just getting seduced by a big, flashy return number, you can ask the right questions. You can understand what's really going on. So the only question left is, how are you going to evaluate it now?
All right, welcome. Today we're going to tackle a single word, one you see everywhere, that shapes headlines, drives investment decisions, and, let's be honest, constantly fools our intuition. And that word is correlation. You know, our brains are just incredible pattern-matching machines, right? We're wired to find connections and make sense of the world. But here's the thing. When we try to use stats to prove those connections, our own intuition can lead us straight into a trap. So today, we're going to explore just how this powerful tool can fool us if we're not super careful.
Okay, so first things first, let's get a solid definition down. The correlation coefficient, you'll see it called R, it's basically just a scale. It goes from -1 to +1. +1, that means a perfect positive relationship. -1, a perfect inverse relationship. And 0 means, well, no relationship at all. But you have got to pay attention to that word I've highlighted on the slide, linear. Honestly, that is the single most important word here. It's the key to unlocking all the mistakes and fallacies we're about to dive into.
All right, let's jump right in with our first big myth. This idea that any strong, totally obvious relationship just has to have a high correlation. Let's see about that. So take a look at this scatter plot with me. On the horizontal axis, you've got the S&P 500's monthly return, and on the vertical axis, we've got the return of a hypothetical options strategy. What you're about to see is a pattern that looks incredibly clear and, well, predictable. So here's how this strategy works. It's pretty simple, actually. When the market is flat, it makes the most money. As long as the market kind of stays in this channel, say between plus or minus 6%, it's profitable. But if the market moves dramatically, either up or down, the strategy starts to lose money. And you can see it right there. The relationship forms this perfect, clean arc. I mean, it's an incredibly strong and predictable connection, right?
Okay, so look at that arc. It's perfectly predictable. What would you guess the correlation is? 0.8? 0.9? I mean, it has to be super high, right?
The correlation is 0, a perfect 0. And this is what's so interesting because this slide perfectly exposes correlation's biggest single blind spot.
So why? What's going on? Well, the crucial point is this. Correlation is only trying to fit a straight line to the data. But the data here, it's a curve. So the positive relationship you see on the left side of that arc, it perfectly cancels out the negative relationship on the right side. The best fit straight line ends up being completely flat. And that gives us a correlation of 0. It's telling us there's no linear relationship, even though our own eyes can see a very, very strong non-linear one.
Okay, so that leads us perfectly into our second and probably most famous fallacy, the classic correlation equals causation trap. We've all heard this one.
And oh man, this next graph just illustrates the point brilliantly. What we're doing here is plotting the number of hedge funds in existence against U.S. wine consumption over a 10-year period. I mean, just look at that line. It's almost perfectly straight.
In fact, if you look at the R-squared value, which basically tells us how much of the change in one thing is explained by the other, it's 0.99. 0.99. That means this model is a 99% perfect fit. Statistically speaking, that is about as flawless a connection as you could ever hope to find.
So this stunningly high correlation, it leads to some, well, pretty ridiculous potential conclusions, doesn't it? Like, do hedge funds drive people to drink? Should wine growers start marketing directly to hedge fund managers? Does launching a new fund just make people thirsty? I mean, it sounds absurd.
And of course, it is absurd. What we're really looking at here is something called a spurious correlation. There's a hidden variable, an invisible force that's driving both of these trends. And that variable is time. You see, over that specific decade, the U.S. economy was growing, wealth was increasing, and as a result, both the number of hedge funds and the amount of wine people drink saw these steady growth trends. They aren't causing each other at all. They're both just moving in the same direction at the same time, thanks to this other factor.
All right, now for our third and final myth. And I've got to say, this one is the most counterintuitive of all. It's really going to challenge the way most of us, especially if you're an investor, think about risk and diversification.
Okay, pop quiz time. We've got two funds, and we're comparing them both against the S&P 500. Now, Fund A is pretty straightforward. It's always up when the market is up, and it's always down when the market is down. Fund B, well, Fund B is a little different. So which one do you think has the higher correlation to the market? Okay, here they are, side by side. On the left, you've got Fund A. Notice how its bars always move in the same direction as the S&P's bars. And on the right, there's Fund B. So take a really close look. Which one seems more tightly linked to you? And the answer is, drum roll please, Fund B has a perfect correlation of 1.0, a perfect one. Meanwhile, Fund A, the one that always goes down with the market, has a much lower correlation of just 0.41. I mean, how is that even possible? Fund B never loses money when the S&P is down. This seems completely backwards. Okay, this scatter plot is going to explain the whole mystery. Remember that keyword, linear? Well, because the returns of Fund B move progressively higher in a perfect straight line as the S&P's returns increase, the linear relationship is mathematically perfect. So even when the S&P is down, Fund B's returns are just, well, less positive, but they still fall perfectly on that straight line. Correlation sees that perfect line and says, yep, that's a 1.0. And this right here, this reveals the massive practical problem with relying only on correlation. It just doesn't measure what an investor actually cares about. What do we care about? We care about losing money when the whole market is losing money, right? But here's the irony. The fact that a fund does great when the market is doing great actually raises its correlation, which then makes investors think it's risky or not diversified. It's completely backwards. So the takeaway here is that we need better tools. We have to stop relying on this one single, often misleading number.
We need to start asking more specific, smarter questions. Questions like, how often does this investment actually make money during months when the market is down? And hey, what's its average return during those same tough months? These are the stats that get to the heart of what we really want to know about risk. But wait, there's one more essential tool we need to add to our kit. You can think of it as correlation's more practical, more insightful cousin, beta.
So while correlation just tells us if two things tend to move in a straight line together, beta tells us how much we can expect one to move when the other one does. For example, a beta of 2 means that for every 1% the market moves, the investment is expected to move 2% in the same direction. See? That's a much better gauge of real-world impact than just correlation alone.
So to really wrap your head around the relationship between investments and to assess risk properly, you need a full toolkit. Here's your new process. Step 1. Use correlation to just flag a potential linear relationship. Step 2. Use beta to understand the magnitude of that relationship's impact. And finally, step 3. You stress test it. You look at its actual performance during the tough times, those down market months.
Ultimately, it really all comes down to this one simple but really powerful idea. Your data, your numbers, they'll tell you whatever story you ask them to tell. So instead of getting fooled by a single generic stat like correlation, the key is to ask the right questions, measure what you are actually worried about. And that is how you go from just seeing patterns to truly understanding what's real.
All right, let's jump right in. When you think of the person who invented the modern hedge fund, you probably picture some Wall Street hotshot, right? A numbers guy in a suit. Well, what if I told you it was actually a 48-year-old sociologist and journalist? Yeah, that's where this whole story starts, with a total outsider who accidentally created a revolution that completely reshaped finance. So picture this. It's April 1966. Fortune magazine drops this article with a headline that just grabs you. For 17 years, this incredibly secretive investment fund had been operating under the radar. And now, suddenly, the world was about to find out it was blowing every other fund on the planet out of the water. And the numbers revealed in that article, I mean, they were just jaw-dropping. Take a look at this. Over the last decade, Alfred Winslow Jones's fund had returned a mind-boggling 670%. To put that in perspective, the top mutual fund at the time, Dreyfus, did 358%. And here's the kicker. Jones's numbers were after he took his massive 20% performance fee. This kind of performance was completely unheard of. Naturally, this was the question on everybody's lips. The article created an instant mystery. Who in the world was this A.W. Jones? And how on earth did he build a money-making machine that was just so far ahead of everyone else? Well, the answer was not what anyone was expecting. Turns out, Jones wasn't a Wall Street guy. He wasn't even a finance guy. He was a complete outsider, an academic, a journalist, who basically just fell into the world of investing. And his background, well, it was eclectic to say the least. Harvard grad, sure. But then he's a diplomat in pre-war Berlin. He's observing the Spanish Civil War. Then he gets a PhD in social science from Columbia and starts writing for Fortune. Notice what's missing from that list. Yeah, literally anything to do with stocks, bonds, or finance. His entire world was politics and sociology. The big career change came super late in life. It's 1949, he's 48 years old, and Fortune assigns him an article on stock market forecasting. While he's researching it, he gets completely convinced that he's found an edge, a better way to do things. So, what does he do? He quits his job, scrapes together $100,000, 40,000 of which was his own money, and just like that, he starts his own investment partnership. So, because he had zero formal finance training, Jones came at the market from a totally fresh perspective. You have to remember, back then, investing was pretty simple. You bought stocks you liked in a mutual fund and just hoped the market went up. That was the whole game. The strategy Jones came up with was completely alien to Wall Street, and it was all built around this wild, counterintuitive idea. Now, to really get what he did, we have to talk about short selling. It's basically betting against a company. You borrow shares, you sell them on the market, and you pray the price tanks so you can buy them back cheaper, return them, and pocket the difference. It's always been seen as a super risky speculative move. But Jones looked at it totally differently. This quote really sums up his whole philosophy. For him, short selling wasn't just gambling. He saw it as a powerful tool for controlling risk, a way to protect his investors. And this is the genius of how it all worked.
Instead of just being 100% invested, he'd used leverage to buy, say, 130% worth of stocks he thought would go up. But at the same time, he'd short 70% worth of stocks he thought were dogs. So his total investment, his gross exposure, was a huge 200%. But, and this is the key, his net exposure to which way the market was going was only 60%. Those short positions acted like a cushion, a hedge, against a market crash. So what this does, and this is the truly brilliant part, is it basically neutralizes the overall market's movement. It didn't really matter if the whole market went up or down. The only thing that mattered was a manager's skill in picking winners for the long book and losers for the short book. His model became a pure, unadulterated test of stock-picking talent. Okay, so Jones designs this incredible machine that amplifies a manager's skill. But that brings up a pretty big question, right? How did a sociologist with absolutely no background in finance suddenly become the best stock picker on the planet? I mean, was this guy who stumbled into finance at age 48 secretly some kind of stock-picking savant? Did he have some hidden God-given talent for reading financial statements? The answer? A big fat no. He admitted it himself. He had zero passion for the nitty-gritty of financial analysis. See, his true genius wasn't in picking stocks. It was in picking the people who could pick stocks. And he built this amazing system to do it. He paid outside brokers for their best ideas. He hired multiple portfolio managers internally and gave them each a chunk of money to run. And this is the most important part. He paid them based on how well they performed, individually. The guys who made the best calls got a bigger cut of the profits and more capital to manage. He basically invented the very first multi-manager hedge fund. But those powerful incentives, they had a dark side. In 1966, the very same year as that big Fortune article, the SEC came knocking. Apparently, a broker learned that Douglas Aircraft was about to post some terrible earnings. He allegedly tipped off one of Jones's managers, who then went and shorted the stock right before the bad news hit the public. It was a classic insider trading case, and it showed how that intense pressure to perform could lead people to cheat. It leaves you wondering how much of that early success was skill and how much was something else. But controversy or not, you just can't deny how revolutionary his core ideas were. Jones's innovations didn't just make him a fortune, they literally laid out the blueprint for the entire modern financial industry. For example, take the modern concept of beta. It's a standard tool now. It basically measures how risky a stock is compared to the overall market. So a stock with a beta of 2 is expected to be twice as volatile as the market index. This is how it's calculated. You just plot a stock's daily price moves against the market's moves. That line that cuts through the data points, its slope is the beta. This is a cornerstone of how people think about risk today. Well, get this. Decades before beta was a thing, Jones had already invented his own version he called relative velocity. But instead of looking at tiny daily wiggles, he measured how a stock did during big market upswings and downswings. You could argue it's an even more practical measure for a real trader. It just goes to show how far ahead of his time the guy really was. In the end, his whole legacy really boils down to these 3 pillars. And this became the DNA for the entire multi-trillion-dollar hedge fund industry. 1, hedging with short sales to isolate skill. 2, using leverage to magnify that skill. And 3, the performance fee, the famous 2 and 20, which rewards managers for actually performing, not just for gathering assets. And the funny thing is, the man who started it all wasn't even a fan of the term hedge fund. He originally called his creation a hedged fund, which, if you think about it, makes more sense grammatically. He reportedly couldn't stand the term hedge fund and thought it was just a clunky corruption of his original idea. And maybe that's the final twist. Alfred Winslow Jones, the accidental financier, he designed this model for a very specific reason: to use risky tools for conservative goals, to get rid of market risk, and to purely reward the skill of picking winners and losers. When you look at the massive, complex, sometimes crazy industry that grew out of his idea, you just have to ask, does it still reflect that original vision? All right, let's get into it. Hedge funds. You've definitely heard the term thrown around, right? They're one of those things in finance that are talked about all the time, but very few people actually understand what they are. They're wrapped up in this cloud of mystery and, well, a whole lot of money. So, what's the deal? I think this quote from Cliff Asness is just the perfect place to start. It's kind of cynical, a little funny, but it's also pretty spot on. It really nails that feeling of exclusivity and the high-stakes world that we're about to jump into.
So here's the thing. There isn't really one simple definition of a hedge fund. And the reason for that is they're all so different from each other. In finance, they call that being heterogeneous. So probably the best way to get a real handle on what they are is to understand what they are not. And to do that, we're going to compare them to something we're all a lot more familiar with, the mutual fund.
And really, this comparison is where the light bulb starts to go on. We're going to break down some of the huge differences between these two types of investments, and you're going to see pretty quickly why hedge funds are playing a totally different game.
Okay, first up, what are they even trying to do? A mutual fund, that's on the right, is all about relative return. That just means its goal is to beat a benchmark, like the S&P 500. So think about this. A fund manager could lose 20% of your money, but if the S&P 500 lost 23%, they get to call that a win. It's wild, but that's superior performance. A hedge funds, though, they're chasing absolute return. The goal is simple. Make money, period. A loss is a failure. No excuses. They don't care what the market did.
And because their goals are so different, what actually drives their success is also completely different. A mutual fund is basically just buying and holding stocks, right? So its fate is completely tied to the overall direction of the market. If the market tide goes up, it goes up. But a hedge fund? Its success or failure really comes down to the manager's skill. The specific calls they make matter way, way more than what the broader market is doing. So how is that even possible? Well, they have a bigger toolkit.
And here are the two most important tools in that kit. First, you've got short selling. This is the big one. It's how a fund can actually bet on a stock's price going down. It's the hedge in hedge fund. Then you've got leverage, which is really just using borrowed money to make your bets bigger. The potential for reward is higher, but of course, so is the risk. When you put these two things together, you unlock this whole universe of strategies that a normal mutual fund just can't touch. Okay, so theory is one thing, but let's actually see what this looks like. This next visual is a fantastic way to understand how these tools actually change how much risk a fund is taking from the overall market.
All right, let's start on the far left with the mutual fund. Super simple. The black bar shows it's 100% long. It owns stocks. That's it. So its gross exposure, that's your longs plus shorts, is 100%, and its net exposure, longs minus shorts, is also 100%. This is our starting point. It's totally exposed to every little move the market makes. Now look at the middle section, the equity hedge fund. This is where it gets really interesting. See that white bar? That's a 60% short position betting against certain stocks. And the black bar shows they're 110% long on stocks they really like. So their total bet, the gross exposure, is a massive 170%. That's leverage. But here's the critical part. Look at the net exposure. It's only 50%. So even though they have way more money in the game, their actual risk from the market going up or down is half of what the mutual fund has. That's the whole idea. Now let's take this idea to the extreme. Look at the far right, the equity market neutral fund. Here, the long bets and the short bets are almost perfectly balanced. The net exposure is basically zero. This fund is not betting on the market going up or down at all. Its entire performance is a pure bet on whether the manager's stock picks go up more than their short picks go down. It's all about skill. So if these funds have all this flexibility, you're probably wondering, why isn't everybody invested in them? Well, this slide pretty much tells you everything you need to know. First, the fees are high. But beyond that, you generally need to be an accredited investor, which is a fancy way of saying you need to have a high net worth, usually over $1 million. And maybe the biggest difference is liquidity. Your money is tied up. You can't just click a button and get your cash tomorrow like with a mutual fund. There are lockup periods and gates that mean your money could be stuck for a year or even longer. So this whole setup, the ability to go short, use leverage, and chase those absolute returns, it just unleashes an incredible number of different ways to invest. We've really only just scratched the surface. The hedge fund world is absolutely massive and incredibly diverse. The one we just looked at in that chart, the equity hedge fund, that's kind of the classic model. It's the most common strategy out there. A manager thinks some stocks are winners and some are losers, and they build a portfolio to try and make money on both of those ideas. But these strategies can get way more specific. Take something like merger arbitrage. Let's say company A announces it's buying company B. The stock price of company B will jump up, but it'll usually trade just a little bit below the final deal price.
A merger arb fund comes in, buys the stock, and is basically betting that the deal will go through, hoping to capture that small, hopefully safe profit. The risk? The deal falls apart. But notice, the success of this has almost nothing to do with what the S&P 500 is doing that day.
Or you could have a completely different strategy, like global macro. These guys aren't picking individual stocks. They're making huge bets on the direction of entire countries or economies. They might think the US dollar is going to get stronger, or that interest rates in Europe are going to rise. They're trading on the big picture.
And honestly, the list just goes on and on. You have funds that specialize in buying the debt of bankrupt companies, funds that use supercomputers to find tiny pricing mistakes. It's just endless. The main thing to get here is that hedge funds aren't just one thing. They're this huge collection of super specialized expert strategies.
So with all this variety, right, with all these different strategies specifically designed to do their own thing and not be tied to the market, is there anything that actually links them all together? Well, it turns out there is, and it usually only shows up when things get really bad.
There's this famous saying in finance, correlations go to 1. It's a fancy way of saying that in a real, full-blown market panic, think 2008, all that diversification just goes out the window. When everyone is scared and needs cash, they just sell whatever they can. It doesn't matter what it is. And in that moment, all these brilliant, unconstrained strategies can all start moving in the exact same direction, straight down.
And that kind of leaves us with the big final question, doesn't it? The whole point of a hedge fund is to be unconstrained, to be free from what the market is doing. But when a true crisis hits the entire system, can anything or anyone really be free from the same fate as everyone else? It's definitely something to think about.
Let's talk about one of the most misunderstood and frankly mythologized topics in finance, hedge funds. When you hear that term, what pops into your head? Probably high stakes, high risk, Wolf of Wall Street kind of stuff. But what if I told you that for most people, the common wisdom has it completely 100% backwards? First, let me ask you something. What does the term conservative investment actually mean to you? No, really, think about it for a second. You're probably thinking words like safe, stable, slow and steady wins the race. Got it? Okay, hold on to that definition because we are about to put it to the ultimate test. All right, have a look at this chart. We've got two different investments here tracked over a long 22-year period. Now, over the long haul, they ended up in a pretty similar place. The solid line made about 8.2% a year, the dotted line made 7.4%. So not a huge difference in the end result. But just look at their journeys. One is an absolute roller coaster of stomach-churning ups and downs. The other is a much smoother ride. So based on your definition of conservative, which one would you pick? Go ahead, choose one. The crazy solid line or the steady dotted line?
Okay, you got your answer locked in? Great. Let's solve this little financial riddle.
If you're like most people, you probably pointed right at that smooth, steady, dotted line. It just looks safer, right? Well, congratulations, you just picked a diversified portfolio of hedge funds as the more conservative investment. And that wild, jagged line that looks like a heart rate monitor during a horror movie, that is the S&P 500. The benchmark for the 500 biggest U.S. companies, the thing that's supposed to be the bedrock of so many traditional portfolios. This one chart just completely flips the script on the popular narrative. So the big question is, why is the reality so different from what everyone thinks? And this gets us right to the core of it all. The huge gap between how we perceive hedge fund risk and what the actual data tells us. Let's dig into the numbers behind those terrifying nosedives you saw in the S&P 500 chart.
So, from late 2007 to early 2009, right in the middle of the great financial crisis, the S&P 500 lost 51% of its value. Half gone.
And that wasn't just a one-off catastrophe. Remember the dot-com bust back in 2000 to 2002? It lost 45% then, too. Now here's where it gets really mind-blowing. The absolute worst drop for that hedge fund index over the entire 22-year period? Just 22%. Think about that for a minute. That is less than half the size of the S&P's second worst crash.
And when we lay the numbers out side by side, the whole story just snaps into focus. You can see the annual returns are pretty close, right? But now look at the risk numbers. The standard deviation, which is just a fancy way of saying how bumpy was the ride, was over 15% for the S&P versus less than 6% for the hedge funds. The maximum drawdown, like we just saw, was a terrifying 51% versus a much more manageable 22%. So the real punchline is in these last two columns, the return you get for the risk you take. By either measure,
The hedge fund portfolio delivered more than double the bang for your risk-adjusted buck.
Okay, so we've seen what the data is screaming at us. Now let's talk about the why. And the secret ingredient, the magic sauce, is something often called the only free lunch on Wall Street: diversification.
Think about a normal investment portfolio for a second. You really only have two main tools in the toolbox: stocks and bonds. And a lot of the time, they kind of move together. But hedge funds, well, they have access to this incredible range of strategies that regular funds just can't touch. The source material puts it beautifully. It's like having a richer palette of investment colors to paint with.
And it's this ability to combine so many different strategies that don't move in lockstep with each other that's what absolutely crushes the overall risk. It leads to this fantastic quote: "Diversification may be the only free lunch on Wall Street, but it is served at a diner accessible only to hedge fund investors."
Now, I know what some of you are probably thinking. Yeah, that all sounds great, but what about the horror stories? The funds that blow up and lose everything overnight? And you know what? That's a totally valid concern. It's called single fund risk, but thankfully there's a well-known solution.
And that solution is called a fund of funds. It's basically a two-part safety net. First, you have a team of pros whose entire job is to do deep background checks, kicking the tires and screening out the bad apples. But second, and this is the real magic, they build a portfolio for you that's spread across tons of different hedge funds, usually somewhere between 10 and 50 of them. That diversification is an incredibly powerful shield.
And this really drives home just how powerful that shield is. Let's play out the absolute worst-case scenario. Imagine you're in a fund of 30 different hedge funds, and one of them, just one, completely implodes, goes to zero, a 100% loss. Well, because it was only one small piece of your diversified portfolio, the total damage to your investment is just a 3.3% loss. I mean, that's less than what a typical stock fund can lose in a bad month.
So, the usual objections you hear about funds of funds are the extra layer of fees and the sky-high investment minimums. And look, those are fair points. But the reality is, for most individual investors, a fund of funds is the only practical way to get access to this kind of portfolio. And here's the really crucial part. Remember all those superior risk-adjusted performance numbers we just looked at? All of those were calculated after taking that double layer of fees into account.
But what happens in a true five-alarm fire market panic? You know, those moments when it seems like all diversification fails and absolutely everything starts going down at the same time. Well, it turns out there is one type of strategy that has historically been the exception to that rule.
This scary phenomenon is called correlations going to 1. It just means that when panic sets in, investors just hit the sell everything button. Stocks, bonds, real estate, you name it. Everything starts moving in lockstep straight down. And that beautiful diversification you thought you had, it can vanish right when you need it most.
The big exception here is a strategy called managed futures. These funds are basically betting on the direction of big market trends, and they behave totally differently in a crisis for a few key reasons. First, they operate in markets that are incredibly liquid, so they can get in and out of positions in minutes. They can also easily flip their bets and start shorting the market. This means they have the potential to actually profit from the same fear and downward momentum that is crushing every other type of investment.
Okay, let's bring this all home. It's time to take what we've learned, dismantle the biggest myths out there, and completely rethink what conservative investing actually looks like.
So, misconception number 1. Hedge funds are a high-risk gamble you take for massive returns. Well, the reality we've seen in the cold, hard data is that a properly diversified hedge fund portfolio is actually a conservative investment. It provides moderate returns with dramatically less risk than just owning stocks.
And misconception number 2, you can lose all your money in a hedge fund. Well, yes, that is absolutely a risk if you put all of your eggs in one single basket. But that's a risk of not diversifying, not a risk of the investment type itself. It's no different than putting your entire life savings into a single stock like Enron. And we already know the solution for that, a diversified fund of funds.
So when you look at all the evidence, it completely flips the conventional wisdom on its head. The question we should be asking isn't, would you really put your grandmother in hedge funds? After seeing the stock market collapse by nearly 50%, not once but twice in 2 decades, the real question we should be asking is, would you really put her in traditional stock mutual funds? And that is a provocative thought to end on, one that challenges all of us to look past the headlines and focus on the reality of risk.
Have you ever heard a story that's so powerful, so dramatic, that it completely changes how you see the world? A story that just sticks with you and overshadows all the facts and data?
Well, today we're diving into one of those stories. It's a tale from the world of high finance that has secretly shaped how pretty much all of us think about risk, whether we realize it or not.
And to really get how easily our brains can be tricked when it comes to risk, we're not going to start on Wall Street. Nope. We're going to start in a storybook kingdom. It's a simple little parable, but trust me, its lesson is incredibly profound, and it holds the key to everything else we're going to talk about. So our story begins in this place called the Kingdom of Financia. And like any modern society, they were all about progress, all about innovation. But with that progress came a brand new, totally unforeseen danger. The people of Financia absolutely loved their new cars. I mean, who wouldn't? They offered freedom, speed, the whole deal. But as the roads got more and more crowded, accidents started becoming terrifyingly common. People were getting hurt, and the kingdom was getting desperate for some kind of solution. Then, a brilliant inventor steps up with this revolutionary new device, the seatbelt. Super simple idea, right? Just a strap designed to hold you in your seat if you crash. A real life-saving innovation. Okay, so here's the thing. This kingdom had this prince who everybody loved, but he had one big, dangerous flaw. He was a terrible, reckless driver. So, of course, he gets one of the first cars with this new seatbelt. And that extra feeling of safety, well, it didn't make him more cautious. It actually made him feel invincible. He started driving even faster than before. And then the unthinkable happens. He's speeding down some winding mountain road, he loses control, and the crash is just catastrophic. The beloved prince is killed. And the news that rips through the kingdom had one shocking, unforgettable detail. He was wearing one of those newfangled seatbelts.
And that was it. That one story became the story. The tragic death of this one single high-profile person completely erased all the potential good of the invention. The people of Financia wanted nothing to do with seatbelts. Manufacturers stopped putting them in cars. And whenever the poor inventor tried to show them data, proof that they actually saved lives, he'd just get the same response over and over. Remember what happened to the prince. The story was just way more powerful than the truth.
Okay, so let's bring this back from our parable into the real world. Because Wall Street had its own prince. It had its own dramatic, unforgettable story that has shaped how we think about risk for decades. And that prince was a company called Long-Term Capital Management, or LTCM. It was a type of investment firm known as a hedge fund, whose entire purpose, ironically, was supposed to be managing risk.
So, what even is a hedge fund? Well, in the simplest terms, it's an investment fund that uses really complex strategies to try and make money no matter what the market is doing, up or down. The name actually comes from the idea of hedging your bets, protecting yourself from losses. Because they're so complicated, they're typically only for really experienced, wealthy investors.
The story of LTCM is like a financial thriller, seriously. It was founded in 1994 by this absolute dream team of Wall Street legends, including 2 Nobel Prize winners. They seemed totally invincible, and for 4 years, they were. They delivered these incredible, steady profits. But in 1998, they got cocky, they got reckless, they started making much riskier trades. And right at that moment, a financial crisis in Russia kicks off a chain reaction that completely unravels them. By September, the whole thing implodes so spectacularly that the U.S. Federal Reserve had to step in and orchestrate this massive bailout just to keep the entire global financial system from melting down.
In just 5 months, LTCM lost 92% of its value. Think about that. A near total wipeout. Just gone. The Prince of Wall Street had crashed.
And this became the story everyone remembered. You see where this is going, right? It's the exact same logic as our parable. The question wasn't about the data. It was all about the drama. People thought, hey, if a fund run by actual Nobel-winning geniuses can lose everything, then surely all hedge funds are just ticking time bombs. Remember what happened to LTCM became the new warning.
But what if that powerful story doesn't actually tell the whole truth? What happens when we push aside the dramatic tale of LTCM for a second and just look at the cold, hard data of how hedge funds have actually performed over the years?
Let's take the dot-com bust from 2000 to 2002. The tech-heavy NASDAQ got absolutely crushed, losing a staggering 75% of its value. The broader S&P 500 lost 45%. And hedge funds, these supposedly super risky investments, well, on average, they basically broke even. They were the seatbelt. Okay, fine. But what about the big one, the great financial crisis of 2008, the biggest meltdown in generations? Well, again, the data is pretty surprising. The stock market lost more than half its value. Hedge funds definitely took a hit, don't get me wrong. They fell 22%, but that's less than half the loss of the broader market. Once again, they provided some serious protection when things got ugly. And this leads us to the central question of this whole thing. If one investment loses 22% in its worst ever crash, how on earth can it be seen as riskier than another investment that has lost over 50% twice? Why does the dramatic story of LTCM just completely drown out all of this data?
Well, the answer doesn't have much to do with finance, actually. It has everything to do with human psychology. Our brains, it turns out, are hardwired to be pretty terrible, pretty illogical when it comes to judging risk. I mean, think about it. We are terrified of shark attacks, which are vanishingly rare, but we're way less scared of drowning, which is a much, much more common danger. We get nervous about flying, but we hop in our cars every day, even though driving is statistically so much deadlier. Why? It's because our sense of risk isn't really based on statistics. It's based on emotion, on drama, and on a few predictable mental shortcuts our brains love to take. Psychologists have names for these mental shortcuts, or biases, and there are 3 that are really key to our story here. First, there's the familiarity bias. We're just scared of what we don't understand. Second, the media bias. Our attention gets grabbed by rare, dramatic events, not common, boring ones. And finally, the control bias. We fear things we feel like we have zero influence over.
And these 3 biases, they perfectly explain the hedge fund paradox. 1. Familiarity. Most of us are familiar with buying a stock, but hedge funds seem like this complex, mysterious black box. 2. Media. A spectacular blow-up like LTCM is a massive, unforgettable news story that gets talked about for years. A 2% drop in the stock market, that's just Tuesday. And 3. Control. You can sell a stock whenever you want, but hedge funds often have these lockups, meaning you can't get your money out right away. That lack of control just feels risky, even if the actual investment is safer.
So what do we do about this? How do we fight back against these biases and learn to separate the risks that are real from the ones our brains just kind of invent for us? Let's try to build a more rational way of looking at it. Now, to be perfectly clear, this doesn't mean hedge funds are risk-free. Not at all. The fear isn't completely irrational. Frauds and blow-ups like LTCM, while they are rare, they do happen. Their complexity can definitely hide risks you don't see. And those lockups we talked about are a very real issue you have to consider. The point isn't that they have zero risk. It's that our perception of their risk is often wildly out of whack with reality. And that really brings us to the core lesson of all this. Whether we're talking about seatbelts in a parable or hedge funds on Wall Street, the crucial point is this: our own judgment is incredibly vulnerable. It can get hijacked by one dramatic story, blown up by the media, and twisted by our own mental wiring, causing us to fear the Princess crash way more than the thousands of everyday accidents. So I'll leave you with this question. The next time you have to make a decision about risk, and it could be about your money, your health, your career, anything, just take a second and ask yourself, am I making this choice based on the evidence, on the data, or am I just remembering what happened to the prince?
All right, let's kick things off with a real head-scratcher from the world of finance. It's one of those mysteries that just doesn't seem to make any sense. You have experts, right? And they hire other experts to pick their investments. And somehow, the results are, well, they're consistently a letdown. We're talking about the paradox of hedge fund of funds underperformance.
So here's the question at the heart of it all. You've got these professional managers whose entire job is to find the absolute best hedge fund managers out there. They're supposed to be building this best of the best dream team portfolio. I mean, that sounds like a total slam dunk, doesn't it? So why on earth does it almost always fall short? And look, we're not talking about a tiny little gap here. When you actually line up an index of single hedge funds against an index of these funds of funds, the performance gap is just massive. And it's consistent. We're often seeing a lag of 5% or even more year after year. It's this huge, glaring difference that practically screams for an explanation.
Okay, so like any good detective story, where do we start our investigation? Well, the most obvious suspect, the one everyone immediately points their finger at, is the fees. It seems like a pretty simple, open and shut case.
And you know, it's true.
There is an extra layer of fees involved, but those fees are paying for something really valuable. First, you get diversification. Let's be real, most of us can't just write a check to get into 20 different hedge funds. A fund of funds makes that happen. And second, you're paying for professional management. These guys do all the heavy lifting, the due diligence, the manager selection, the constant monitoring. So you're definitely getting a service for your money.
But here is where the plot really thickens. When you actually crunch the numbers, that extra layer of fees, it only explains less than a third of that giant performance gap we just saw. So here's the key. Fees are part of the story, for sure, but they are not the main villain. Something else, something much bigger is going on. The mystery is just getting deeper.
And that brings us to the real aha moment of this whole thing. It turns out the problem might not be with the funds of funds at all. The real problem is with the ruler we're using to measure them. We've been comparing them against a rigged game from the very beginning.
This is the absolute key to unlocking the whole paradox. It's not that funds of funds are doing a bad job. It's that the benchmark we're all looking at, those single hedge fund indexes, is fundamentally broken. It paints a picture of performance that is just wildly, unrealistically rosy.
So you're probably asking, okay, how exactly are these indexes so broken? Well, it all comes down to 5 distinct, incredibly powerful biases that completely warp the data and pump up the performance numbers. Let's break them down, one by one.
First up is the most famous one of the bunch, survivorship bias. It's actually pretty simple. When a hedge fund performs horribly and goes bust, it just kind of quietly gets erased from the index database. So over time, all you're left with are the winners, the survivors, which makes the average performance look way, way better than it truly was. This is such a great way to think about it. Imagine you're trying to figure out the average talent level of a singing competition, but the only people you listen to are the finalists. You completely miss the hundreds of people who couldn't carry a tune and got booted on day one. Your conclusion about the average singer would be totally, completely wrong. Next on our list is selection bias. Now, here's the thing you have to remember. Reporting performance to these big databases is totally voluntary. So who do you think is going to be first in line to share their numbers? It's the funds that are absolutely crushing it, right? If you're having a bad year, you have zero incentive to advertise that fact to the world. It's just like this classroom scenario. If a teacher tried to figure out the class average, but only the students who volunteered their grades were counted, and only the A students raised their hands, well, the class average would look like 95%. That doesn't reflect the whole class at all. And that's pretty much what happens with these hedge fund indexes. Now, this one is especially sneaky. It's called backfilling bias, or sometimes instant history. So a fund has been around for a few years, quietly making great returns. When it finally decides to start reporting to an index, that index will sometimes add its entire past performance into the historical data. This makes the index's history look better, but it only includes the winners, because all the funds that failed during that time, well, they never survived long enough to report in the first place. I mean, just think about how absurd this would be in sports. A brand new player gets called up to the major leagues, and the league says, great, we're adding all your high school home runs to our all-time records. It would instantly inflate the historical stats, but it would be totally meaningless for judging how the league actually performed in the past. So even when indexes try their best to account for survivorship bias, they slam right into another problem, termination bias. Think about it. When a fund is in its death throes, when the losses are just catastrophic, the very last thing on that manager's mind is filling out paperwork to report those awful numbers. So the fund's absolute worst performance, those last few months right before it collapses, often never even gets into the database. Right, it's the exact same logic as a struggling student who officially withdraws from a class the week before the final exam they know they're going to bomb. When the school calculates the final grade statistics for that class, that student's record of C's and D's just disappears. The worst data points are systematically kicked out of the results. All right, last one. This one's a little more technical. It's called allocation bias. See, most of these indexes are equally weighted. Statistically, that assumes that at the end of every single month, you sell some of your winners and use that money to buy more of your losers. In theory, this kind of rebalancing can boost returns. But in the real world of hedge funds with things like lockup periods and redemption rules, this perfect monthly rebalancing is completely impossible.
A really good way to get your head around this is to think about fantasy football. Imagine if your league had a rule that lets you magically trade players in the middle of a game to always have the highest scoring players on your roster. It's a cool advantage on paper, but it's a theoretical one that no real-world coach could ever achieve.
Okay, so we've got these 5 powerful biases all working together to push these single fund index returns artificially through the roof. But here's the beautiful part of this story. The very way a fund of funds is built inherently fixes almost every single one of these problems.
This chart really just brings it all home. Let's just quickly walk through this side by side. Survivorship bias, gone. When a fund inside a fund of funds blows up, that loss is permanently baked into the record. Selection bias doesn't matter. The performance is captured whether the underlying manager reports it or not. Backfilling? Nope. There's no instant history, because performance only starts counting from the day they invest. And termination and allocation biases are also fixed, because a fund of funds reflects actual, real-world, dollars and cents results, not some theoretical database.
So there you have it. We've solved the paradox. It was never really about bad managers. It was about using a bad yardstick. Let's just wrap up with the big takeaway from all this.
So the common belief, the misconception, is that you can just glance at a hedge fund index and get a pretty good idea of how the industry's doing. But the reality, as we've just seen, is that these indexes are so chock full of these upside biases that they dramatically, substantially overstate the true performance. They set an expectation that is almost impossible to meet. And all of this leads to a pretty powerful and definitive conclusion from the source material. The author is asked, when should these flawed single fund indexes ever be used? And the answer is just so blunt and so clear. In my opinion, never. That's just how misleading they really are.
So when you peel it all back, the real story wasn't about underperformance at all. It was about using a broken ruler to measure things. It's a great reminder that the real data, the truth, is often hiding just beneath the surface of those big headline numbers. And that really leaves us with one final thought. Now that you know the secret of these hidden biases, what other statistics and averages out there deserve a second, more critical look from you?
In the world of investing, there's a word that can make just about anyone a little uneasy, and that word is leverage. We've all heard the horror stories, right? But what if I told you the way we've all been taught to think about it, the very first question we ask is completely backwards? Today, we are going to tear down a huge investment myth, the leverage fallacy.
All right, so here's our game plan. First, we're going to define what this fallacy actually is. Then, we'll see why the question we all ask about leverage just doesn't work. After that, we'll get into the really wild idea that leverage can, get this, reduce risk. We'll also cover when it is genuinely dangerous, and we'll wrap up by shifting our focus from leverage to what really truly matters, risk itself.
So what exactly is this leverage fallacy? Well, it all comes down to a really simple but honestly a pretty critical misunderstanding. Investors have seen leverage at the heart of some spectacular financial blowups, so they've learned a lesson, but they've learned the wrong one. They think leverage is dangerous, when the much more accurate lesson is that leverage can be dangerous. Big difference. Mark Twain just nailed this idea perfectly with his story about a cat. The cat sits on a hot stove, gets burned, and learns never to sit on a hot stove again. Great. But it also learns never to sit on a cold stove. And that's exactly what's happened with investors. They got burned, so now they avoid all leverage, even when it's completely safe, like a cold stove. And this fear has led to one universal but totally flawed question. Think about it. When you're looking at a hedge fund or really any investment strategy, it feels like there's one obvious super responsible question you have to ask. You gotta know how much risk they're taking on, right? And there it is. How much leverage do you use? It sounds so smart. It's the question everyone asks. But, as we're about to find out, that question, on its own, is pretty much meaningless.
So why is it so useless? Because leverage is just a multiplier. That's all it is. It takes the risk of whatever you're invested in and dials it up. So asking how big the multiplier is without knowing what exactly is being multiplied, well, that tells you absolutely nothing about the final result.
Okay, let's make this super clear with an example. You've got 2 funds. Fund A has 0 leverage, none, but it holds bonds with a 10-year duration, which means they're really sensitive to interest rate swings. Then you have Fund B. It's leveraged 5-to-1, but it holds super safe bonds with only a 1-year duration. Now, just based on that leverage number, which one feels riskier to you? Come on, everyone would point straight to Fund B, right?
Well, they'd be dead wrong. In reality, Fund B is only half as risky as Fund A.
How is that possible? Because the thing it's multiplying is so incredibly safe to begin with that even after you juiced it up by 5 times, the total risk is still way lower than Fund A's unleveraged but much riskier assets.
Oh, this analogy is just perfect. It really shows how absurd this is. Asking about leverage without asking about the underlying asset is like asking a bank teller to just count the number of bills in their drawer without caring if they're $1 bills or $100 bills. I mean, 10 ones is not the same as 10 hundreds, right?
So here's the mental model you absolutely need to have. This is the whole thing. Total risk isn't just leverage, it's a formula. It's the risk of the stuff you own times the amount of leverage you're using. You simply cannot judge the risk by looking at only one of those two numbers. It's impossible.
And that's exactly why these rigid, one-size-fits-all rules about leverage just fall apart. You know, when a big pension fund says, we won't invest in anything with more than 2-to-1 leverage, that's like making a universal speed limit of 40 miles per hour. 40 is dangerously fast on a winding, icy mountain road, but it's painfully slow on a wide-open, straight highway in the middle of the desert. The right amount of speed and the right amount of leverage always depends on the conditions.
Okay, now we're about to get to the most surprising, most counterintuitive part of this entire discussion, so buckle up. Not only is leverage not always a villain, sometimes it can actually be used as a tool to actively reduce your portfolio's risk. And the way it does that is through something called hedging. So how on earth does that work? Let's just walk through it step by step. Imagine you start with a totally normal fund. It's 100% long, meaning it just owns stocks. No leverage. Okay, now you introduce 2-to-1 leverage. But, and here's the key, instead of using that borrowed money to buy even more stocks, you use all of it to short the market. So now for every dollar you have betting on the market to go up, you have another dollar betting on it to go down. And boom, you've just gone from being totally exposed to the market's whims to being market neutral. You actually lowered your risk by adding leverage. Wild. And listen, this isn't just some abstract theory from a textbook. Let's look at a real-world case that popped up in a fund-to-funds monitoring report. A big red flag was triggered for one of the credit funds in their portfolio.
So, the alarm bells start ringing. Why? Because the fund's gross leverage hit 5.2 to 1. That's the highest it had ever been. Now, on the surface, that number looks absolutely terrifying. This is exactly the kind of thing that makes investors panic and head for the exits.
But when they actually dug into the details, they found something fascinating. At the very same moment the gross leverage was spiking to an all-time high, the fund's net exposure, that's what it really stood to lose if the market tanked, had actually dropped to 1.8 to 1. That was its lowest level in 2 years. All that extra leverage was being used to hedge.
And here's the kicker. The fund's beta, which is just a fancy way to measure how volatile it is compared to the market, was only 0.6. What does that mean? It means that even with over 5-to-1 leverage, this fund was actually 40% less volatile than a totally unleveraged bond index. More leverage, in this case, literally meant less risk.
Okay. Now, of course, this doesn't mean leverage is some magic potion that's always good for you. The fear that everyone has isn't totally crazy. There are very specific, very real situations where leverage can become incredibly dangerous.
So, what are the real red flags you need to watch out for? It basically boils down to 3 main danger zones. First, if you're using leverage on assets that are illiquid, stuff you can't sell in a hurry. Second, if your financing isn't stable, meaning the bank can call you up and demand their money back at the worst possible moment. You put those two together and you have a recipe for total disaster. And third, well, it's dangerous when you're just using it to double down on an already super risky portfolio.
So, after all this, where does that leave us? It means we need to throw out our old simplistic rulebook and adopt a much more sophisticated way of thinking about this. We need to stop obsessing over the tool itself and start focusing on how the tool is actually being used.
So first things first, let's just get rid of this misconception that leverage is a measure of risk. It's not. The reality is that risk is a function of the portfolio and the leverage together. Looking at just one of them tells you nothing.
Second misconception, increasing leverage always increases risk. Well, we've just seen that's flat out not true. As that credit fund showed us, when you're using it to hedge, increasing your leverage can actually reduce your risk.
And finally, let's ditch the absolute rule that says you should never leverage an investment. That's just silly. The reality is that for the right strategy, Leverage can be a really prudent, smart tool to dial the risk and return of an investment up or down to whatever level you're actually comfortable with.
You know, this final analogy just brings it all home perfectly. Leverage is like a power saw. Yeah, in the wrong hands, it is incredibly dangerous. But we don't respond to that by banning all power saws and going back to building houses by hand. The solution isn't to be terrified of the tool, it's to demand that it's used with skill, with care, and with responsibility.
So the next time you're evaluating an investment, I want you to stop yourself before you ask, how much leverage do you use? Instead, ask, what is it being used for? What kind of assets is it being applied to? And how stable is the financing behind it? Because the real question isn't about the tool itself. It's about whether you're assessing the tool or the skill of the person who's using it.
All right, so when you're thinking about investing in hedge fund strategies, you've basically got two main paths. There's the traditional way, the pooled fund, and then there's a more direct route called a managed account. Today, we're going to break down why that second option, which used to be kind of niche, is now really the top choice for investors who want more control and a much clearer picture of what's happening with their money.
To really get this, let's use an analogy. Imagine you're buying your dream car, right? You found it and it's available at 2 different dealerships. And get this, they're both offering it for the exact same price. On the surface, it seems like a coin toss. But as we're about to see, what's hiding in the fine print of the deal, well, that changes everything. So, dealer A, let's just say their reputation is murky. And they're not throwing in any extras. Dealer B, on the other hand, has a stellar reputation, and they're including top-of-the-line safety features and an extended guarantee, all for free. Now, who would you choose? It's a no-brainer, right? You'd go with dealer B every single time. But here's the crazy part. In the world of hedge funds, for the longest time, almost everyone chose the equivalent of dealer A. It really wasn't until the 2008 financial crisis blew everything up that people started asking, wait a minute, why are we doing this? Yeah, that crisis really pulled back the curtain on some deep structural problems. It created this incredibly painful situation for investors who, right when they needed their money most, suddenly realized that the control they thought they had was pretty much just an illusion. One of the biggest shocks was something called a redemption gate. Okay, picture this. Markets are in a freefall. Investors are, understandably, rushing to get their cash out. But then, some fund managers just locked the doors. They literally said, nope, you can't have your money. This trapped people's capital, sometimes for years, taking away their liquidity and control at the absolute worst possible moment. And then you had these things called side pockets. This is where a manager takes all the assets that are hard to sell, the illiquid stuff, and just separates them from the rest of the portfolio. So when you ask for your money back, you only get the cash from the easy-to-sell part. The rest, it's stuck in that side pocket, and you're just left waiting, again, often for years, until the manager finally unloads those assets, which is usually for a lot less than they were supposedly worth. So, if the traditional fund structure is so full of these hidden traps, what's the better way? Well, this is where the managed account really shines. It offers a much more direct, transparent, and frankly, investor-friendly way to do things. And here is the absolute key difference. In a fund, you don't own the assets. You own shares in a big, commingled pot of money that the manager controls. But with a managed account, you are the direct owner of the account and everything in it. You just give the manager permission, a limited power of attorney, to make trades for you. That simple shift is everything because it means ownership and control stay right where they belong, with you, the investor. And once you make that shift in ownership, a whole bunch of amazing benefits just cascade down. You get daily transparency into what you own, you get independent pricing every day, the liquidity terms, way, way better. Think monthly instead of quarterly or even yearly. You control every dollar that moves in or out, which is a massive protection against fraud. Redemptions are fast, and you can say goodbye to those awful gates and side pockets. It can even be a more efficient way to use your cash. Okay, so how do you actually get into one of these? Well, there are pretty much 3 ways. If you're a huge institution, you can set up an individual account directly with a manager. For most other people, you can invest in what's called a fund of managed accounts, which is basically a pre-built portfolio of these accounts. Or, and this is really popular, you can use a managed account platform. They offer a whole menu of different managers, and you get to build your own custom portfolio. Now, I know this all sounds almost too good to be true, which naturally brings up some fair questions. So let's just dive right in and tackle the biggest objections people usually have. The first and maybe most important question is, why on earth would a top-tier, super successful manager agree to this? Why would they give up so much control and be so transparent?
The answer is actually pretty simple. It's about access to more money. After 2008, a giant pool of investors, especially the big institutions, started demanding these better terms. So by offering a managed account, a manager can tap into a huge source of capital that they just couldn't get otherwise. For them, it's a really efficient way to grow their assets and, of course, their fees. Okay, on to the next big one, the cost. I mean, it seems logical, right? If you're adding this whole other layer of oversight and structure, doesn't that just make it more expensive for the investor? This is where you really have to look past the sticker price. Yes, there might be a platform fee, but there are so many things that offset it. For one, fee discounts are really common. You don't have redemption penalties. Getting your money back quickly means you avoid cash drag. That's the hidden cost of your money just sitting around doing nothing while you wait. And when you factor in the value of what is basically built-in fraud insurance, the net cost is often tiny, sometimes even zero, compared to a traditional fund.
Another fair point people raise is about choice. If not every single manager offers a managed account, aren't you kind of limiting your options from the get-go? It's true, the total number of managers is smaller, but honestly, that's not really the right question to ask. The real question is, are there enough high-quality managers available to build a fantastic diversified portfolio? And for liquid strategies, which is where this structure makes the most sense anyway, the answer is a resounding yes. There is absolutely no shortage of top-tier talent to choose from. And finally, we get to the one that, at the end of the day, matters most to every investor: performance. There's this idea that floats around that managed accounts sometimes don't do as well as the main flagship fund they're based on. So this performance gap can be real, but it's usually not an accident. It's actually part of the design. See, managed accounts are often set up specifically to exclude a fund's most illiquid investments. It's a deliberate trade-off. You might give up a tiny bit of potential return in exchange for much better liquidity and not having to worry about side pockets. You might also see a temporary lag when a new account is just getting started. The point is, it's usually a structural difference, not a sign that the manager is doing a worse job. Now, it's really important to be clear. Managed accounts are not some kind of magic fix for everything. We need to be realistic about where they fit, and then we can zoom out and look at the bigger picture of hedge fund investing as a whole. And this really gets to the heart of it. Managed accounts are the perfect tool for liquid strategies, but for things like venture capital or distressed debt, where the assets are highly illiquid by nature, they're just not the right fit. The lesson here is simple. Use the right tool for the job. And when the job is investing in liquid strategies, the managed account is almost always the better tool. But even if you have the best structure in the world, it's still worth asking a much bigger question about the industry itself. There's a really provocative book called The Hedge Fund Mirage by a guy named Simon Lack, and he made this jaw-dropping claim that after you account for all the fees, investors as a group would have been better off just buying super safe treasury bills. It's a statement that calls the value of the entire industry into question. So is it true? Could this multi-trillion-dollar industry, when you look at it all together, have actually lost value for the very investors it was supposed to be helping? Well, the data tells a pretty different story. If you look at the HFRX Global Index, the very one Locke used, it returned over 5% a year during that period. That's more than double what T-bills returned. The problem with the mirage argument is that it basically blames the managers for investors' bad timing. People tend to chase returns and pile in at the top, like right before the 2008 crash. An investor who just bought the index and held on would have done much, much better. At the end of the day, a managed account gives investors what they've always needed: more control, more transparency, and just fairer terms. It's just a better, more robust way to invest. But that leaves us with one final and really important question to think about. A better structure can protect you from bad actors and hidden risks, for sure. But does it solve the fundamental challenge of all investing, which is trying to find genuine outperformance, or alpha, in a market that just gets more competitive every single day? That's the real question to ponder.
You know, we've all heard that old rule of thumb, right? Just own about 10 different investments, and poof, you're diversified. It gets passed around so much it feels like one of those fundamental truths of investing. But what if it's just fundamentally wrong? Well, today we're going to dig deep into the numbers and see why that magic number might not be the safety net you think it is.
So that really is the big question, isn't it? How many stocks or funds or whatever do you actually need to hold to be safe? Is it 10? Is it 20? 50? Well, the answer is a little more complicated and honestly, way more important than you probably think.
And here it is. This is the exact idea we're going to challenge today. The common wisdom says that once you hit 10 investments, adding any more doesn't really cut down your risk in any meaningful way. Now, look, this isn't just a number pulled out of thin air. It's actually rooted in some serious academic studies. But as we're about to see, the logic behind it has a critical, and I'd say pretty dangerous flaw.
All right, so here's our game plan. First, we're going to unpack this myth. Then, we'll get into the huge difference between average outcomes and worst-case scenarios. We'll look at two specific dangers: the risk from just pure randomness and the risk of a single catastrophe. We'll also talk about when diversification goes too far, and we'll wrap it all up with the most important takeaway: thinking about diversification as a kind of insurance.
Okay, first things first. Where in the world did this rule of 10 even come from? Like I said, it wasn't just made up. It really does have a basis in academic research, and that gives it this powerful feeling of authority.
But the key, the real secret, is buried in the fine print of those studies. See, they analyze thousands upon thousands of sample portfolios to measure the average drop in risk. And yeah, on average, the data is right. The benefits do start to level off after about 10. But here's the thing. You are not an average of thousands of portfolios. You are one investor with one portfolio. And believe me, that changes everything.
And this right here, this brings us to the absolute core of the argument. The whole problem with the 10 is enough rule comes down to one single critical distinction: the difference between an average experience and a worst-case experience.
Think of it like this. You got two different worlds. The academic studies, they live in the world of averages, where a few total disasters just get washed out by thousands of successes. But you, as an individual investor, you live in a different world. You don't care about the average. You care about avoiding the absolute worst thing that could happen to your portfolio. This is what finance folks call tail risk, that small chance of a super rare catastrophic event that could just wipe you out.
So let's make this real. Imagine one of your funds completely blows up, loses 50% of its value, a total disaster. Now, if you only have 10 funds, that one event just erased 5% of your entire portfolio. Ouch. But if you have 30 funds, the impact is cut down to just 1.7%. The damage is diluted by a factor of 3. See, studies focused on averages completely miss this, but for the unlucky person who actually picked that one bad fund, that difference is absolutely enormous.
Okay, let's dive into the first of two major risks that a small portfolio exposes you to. And this one's a little counterintuitive, because it's the risk of just pure, simple chance.
Yeah, our source calls this randomness risk. And here's the crazy part. Even if your investments are totally uncorrelated, they have no reason to move together, there will be months where, just by a random roll of the dice, a whole bunch of them go down at the same time. Think of it like flipping coins. Even with a perfectly fair coin, you're sometimes going to get a long, ugly streak of tails. And the fewer coins you flip, the higher the chance of a really skewed, unlucky outcome. Now, take a look at this. This chart it's honestly staggering. If you hold just 6 uncorrelated funds, there is a 1 in 3 chance that in any given month, at least 4 of them will lose money. A 34% probability. That is not some rare black swan event. That's a regular old Tuesday waiting to happen, and it's driven by nothing more than bad luck.
Okay, let's look at an even more extreme case. What are the odds that a huge chunk of your portfolio, like 3/4 of it, goes down all at once? Well, with only 8 funds, that probability is 14%. That is a very real risk of a major portfolio-wide loss in a single month. And remember, we're not talking about a market crash where everything goes down. This is just the brutal, cold math of small numbers.
So how do you fight back against bad luck? You add more investments. By simply doubling your funds from 8 to 16, you slash that 14% risk all the way down to under 4%. You cut the probability of getting hit by a catastrophic string of bad luck by more than a factor of 3. Now tell me, does that sound like a minimal benefit to you? Not to me. It's a massive boost to your portfolio's resilience.
So that covers the risk of just random, clustered losses. But now let's turn to the second, and you could argue the most important type of risk, the danger of one of your investments completely and utterly imploding.
This is what's called idiosyncratic risk. It's the kind of risk that's specific to just one company or one fund. Things like fraud, a terrible CEO, or some freak event that only hits one of your holdings. The goal here isn't to prevent that one holding from ever failing. You can't. The goal is to make sure that when it does fail, it doesn't sink your entire ship.
And this chart just shows you the pure power of dilution. Let's say one of your funds takes a massive 30% loss.
With just 8 funds, your total portfolio takes a nearly 4% hit. That really hurts. But just look at what happens when you add more funds. At 16, the damage is cut in half. By the time you get to 32 funds, the impact is less than 1%. You've essentially contained the disaster.
And you can see this so clearly on this graph. Each of these curves represents a single disaster of a different size. A 10% loss, a 20% loss, you get the idea. But notice how steeply all of them drop off on the left side of the chart, right between about 8 and 20 funds. That's the zone. That's where adding more holdings gives you the most powerful protection against a single catastrophic failure.
Okay, now before we all run out and buy 100 different things, we need to add a really important qualification here. Is more always better? Well, not necessarily. Pushing diversification to its absolute extreme comes with its own set of trade-offs.
See, it's really important to remember that this whole argument kind of assumes you can just keep adding high-quality, amazing investments forever. But if diversifying from 10 to 20 means you have to add 10 of your second-tier ideas, well, you might be hurting your returns more than you're helping your risk. And if you take it way too far, you basically just become an index fund and you guarantee yourself average performance. To beat the market, you have to be different from it, and that requires at least some level of concentration. Finding that perfect balance, that's the key decision every single investor has to make.
So, let's bring this all home. What's the single most important idea you should take away from all this? Well, it means we have to completely reframe the very purpose of diversification.
This is it. This is the whole ballgame. Stop thinking about adding your 11th or 15th or 20th fund as a way to squeeze out slightly better average returns. That is not the point. Think of it as paying a premium for catastrophe insurance. You are buying protection against the devastating impact of either a string of just rotten luck or a single unpredictable disaster.
And if you need a real-world example of just how dangerous it is to plan for the average, the source material gives us a powerful and frankly tragic analogy. When engineers designed the levee system in New Orleans, they built it to be strong enough for the average soil strength, not the weakest soil strength. But a levee system, just like your portfolio, is only as strong as its weakest point. When the hurricane came, the average didn't matter one bit. Only the worst case did. So I'll leave you with this question to really think about. When you look at your own investments, have you built a portfolio that's designed for average weather? Or have you paid the premium for the insurance you're going to need when the hurricane finally hits? Thanks for joining me.
Hey everyone, we've all had that classic investment advice drilled into our heads, right? Don't put all your eggs in one basket. It sounds like a no-brainer, but what if adding more baskets could actually be the riskiest thing you could do? Well, in this explainer, we're going to dig into a story that completely flips that idea on its head and uncovers a hidden danger a lot of investors miss. So let's just jump right in with a big question. Picture this. You have 2 portfolios. One has 5 different investment managers, and the other has 15. Which one is safer? Now, your gut, and probably everything you've ever been told, says the one with 15 is the way to go. But as you're about to see, the real answer is way more interesting, and it reveals something fundamental about how investing really works. To really get our heads around this, we're going to follow a little story. And our main character is a guy named Fred. Fred's a really sharp research analyst at a fund of funds firm. And he's just been handed a major assignment, one that's going to push him to think differently about what diversification actually means. So Fred's job is to build a brand new top-tier portfolio. And he's not just picking stocks here, he's picking the people, the managers who run these really complex strategies, things like futures, global macro, and foreign exchange. The goal is to find the perfect blend, something that gives you great returns without all the crazy stomach-churning ups and downs. Okay, so Fred does his homework, he crunches the numbers, and he lands on his final 5 managers. Now, if you look at their individual stats here, they're kind of all over the map. You've got some with higher returns, some with higher risk, that's the standard deviation number. Each one is really its own unique beast. But here's where the magic happens. When Fred puts these 5 managers together, the result is, well, it's pretty awesome. The return at over 11.5% is really solid. But look at those risk numbers. The standard deviation, or the volatility, plummets to just 8%. That's way lower than any of the managers on their own. And that maximum drawdown, the biggest potential loss, is tiny, just 6.5%. This right here is what great diversification is supposed to look like. So Fred's feeling great, right? He's built his portfolio that's strong, makes good money, and is low risk. He's nailed it. But then in walks the boss, Sam.
And Sam, like a lot of people, has a very, let's say, traditional idea of what makes a portfolio safe. So Sam looks over Fred's beautiful work, and his brain just gets stuck on one thing, the number 5. Just 5 managers? To him, that sounds risky. It feels concentrated. His gut is screaming that to be truly safe, they need way, way more names in the mix. And honestly, it's a super common reaction. So what does Sam do? He slides a list across the desk. On it are 10 more managers he's been keeping an eye on. And he tells Fred to add all 10 of them to the original 5. The idea is to triple the portfolio size, from 5 managers to 15. Because, more is always better, right? And you know what? At first glance, you can't really blame Sam. When you look at the average stats for Fred's original 5 managers compared to Sam's new 10, they look almost identical. The returns are basically the same, the average risk levels also incredibly close. Looking at just these numbers, adding Sam's picks seems like a totally reasonable, maybe even smart move to lower risk. So Fred, being the good analyst he is, does what he's told. He goes back to his computer, plugs in all 15 managers, and runs the simulation. He's probably expecting the risk to drop even further. But what comes out is not at all what he expected. In fact, it's the exact opposite. Just look at this comparison. It is absolutely wild. The return? Basically unchanged. But the risk metrics? The standard deviation, the portfolio's volatility, explodes from 8% to almost 11%. And even worse, the maximum drawdown nearly doubled, jumping from a comfortable 6.5% to a much more painful 12%. By tripling the number of managers, they made the portfolio way, way riskier. And this chart just makes it crystal clear, right? Standard deviation is basically how bumpy the ride is for an investor. By adding those 10 diversifying managers, the portfolio's journey suddenly became over a third more volatile. This is literally the exact opposite of what diversification is supposed to do. And this one might be the most important number on the screen. The maximum drawdown is all about pain. It's the biggest hit your portfolio would have taken from a peak to a trough. And in the 15-manager portfolio, that potential pain just doubled. Instead of adding a safety net, Sam's idea of diversification actually threw gasoline on the fire. So you have to be asking, what on earth went wrong here? How did adding more managers who all looked pretty good on their own make the final portfolio so much worse? Well, the answer was hiding in plain sight in a number that Sam didn't even think to look for. And this is where we get to the secret ingredient, the real lesson of this whole story. It turns out true diversification isn't about how many things you own. It's about how those things behave in relation to each other. And there's a name for that relationship, correlation. So what is this correlation thing anyway? Think of it as a number from -1 to +1 that tells you if 2 investments are dancing together. If the correlation is +1, they're in perfect sync, moving up and down at the same time. If it's -1, they're doing the exact opposite. But the sweet spot, the magic number for diversification, is 0. That means they're not dancing together at all. They're each just doing their own thing. And this slide is everything. It's the aha moment. It shows the average correlation between the managers in each group. Look at Fred's original 5. Their correlation was 0.07. That's basically 0. They were all marching to their own beat. Now, look at Sam's 10 managers. Their average correlation was 0.69. That is crazy high. They weren't 10 different investments. They were basically one big echo chamber. This quote from the source material just nails it. Because all 10 of Sam's managers were so highly correlated, they were all using a similar trend-following strategy, they acted like one giant single bet. Adding them didn't spread the risk, it concentrated it. It was like putting all your eggs in 10 baskets that were all sitting inside one much bigger and much more fragile basket. So let's just bust this myth once and for all. The common misconception is that just increasing the number of investments in your portfolio will always make it safer. But the reality, as Fred and Sam discovered, is that adding highly correlated investments, things that all move together, can actually make your portfolio a whole lot riskier. Okay, so now we get it. But how do we avoid making the same mistake Sam did? Well, the good news is there's a simple number you can look at, a sort of secret weapon to help you measure real diversification. And yep, it's the same one solved our mystery.
Think of average pair correlation as your diversification gauge, and any good portfolio manager should be able to give you this number. The source material gives us some handy rules of thumb. If you see a number over 0.50, like with Sam's managers, that's a big red flag. The diversification is probably pretty poor. Between 0.30 and 0.50 means it could be better. But if you see a number below 0.20, like Fred's original portfolio, you know you're looking at a genuinely well-diversified set of investments. All right, let's wrap this up with the big takeaways. First, real diversification is about the quality of the differences in your portfolio, not just the quantity of lines on your statement. Second, low correlation is the secret sauce. It's way more important than just owning a lot of stuff. Third, if you see a portfolio where a bunch of managers are all doing the same basic thing, be careful. And finally, don't be shy. Ask for the data. Ask for that average pair correlation. It'll tell you what's really going on under the hood. And that leaves us with one final thought, a question for you to take with you. Take a hard look at your own investments, whatever they may be. Are they truly different? Do some of them zig when others zag? Or have you, maybe without even realizing it, built a portfolio like Sam's, one that looks diversified from the outside, but is really just a bunch of investments all marching to the exact same beat? The answer to that question could be everything.
All right, today we're diving into an investment strategy that is, well, it's pretty out there. It's so counterintuitive, it actually got nicknamed Robin Hood investing. So let's just jump right in with a question that'll probably make you scratch your head. What if the best way to grow your money was to take from your winners and give it to your losers? Yeah, I know, it sounds completely backward, right? But stick with me, because the story behind this idea, well, it's backed by some seriously powerful math.
Okay, so this whole thing starts with a financial analyst. This guy was a real expert in his field, and he was looking at these things called multi-manager funds, and he stumbled upon an idea that just seemed almost too simple.
So what's a multi-manager fund? It's pretty straightforward, really. Think of it like a portfolio of people instead of stocks. The fund doesn't pick individual companies, it picks a bunch of expert managers, each with their own unique strategy, and then it splits the money between them. Now, the analyst's big light bulb moment came from a pretty humble starting point. He just assumed, that you can't really predict who's going to be the star performer next month or next year. He figured that past performance, it's just not a great crystal ball. So if you can't pick the winner, what do you do? Well, his idea was simple. Just hit the reset button every month. Rebalance the money so that every single manager has an equal piece of the pie again. And he came up with a really great way to explain this. Imagine each manager's monthly results are like the same deck of cards, just shuffled differently. One guy gets the ace this month, another one gets it next month. Rebalancing is basically like averaging out everyone's hand every single month. It smooths out all that randomness, and the idea is that should give you a better overall result. And here's where the math really clicks. Take a look at this simple example. You've got manager A who's up 10% then down 5%, and manager B does the exact opposite. If you just let them ride, you end up with $1,045. But, and this is the key, if you rebalance after that first month, take some profit from the winner and give it to the other guy, you actually end up with more money, $1,050.60. Look, it's not a huge difference here, but it's proof that there's a real powerful mechanical effect at play. So our analyst has this killer logic. He's got some data to back it up, and he decides, okay, time to pitch this to the bosses. He's feeling pretty good about it, thinking he's found something huge. And this is where things get interesting. And he wasn't just winging it either. He'd actually run tests on 30 different groups of managers. And what he found was that rebalancing worked like a charm, again and again. It was kind of like getting the best of both worlds. You captured the big returns from the top performers, but you kept the low risk of the safest ones. I mean, it seemed perfect. So, picture this. He walks into the big meeting feeling on top of the world. He's got his data, he's got these nice colored charts, the whole deal. He gives this 15-minute presentation that he's sure is a total home run. He finishes, leans back, and is probably waiting for a round of applause. But instead, he gets a reaction that completely blindsided him. His boss just blurts out, "You mean you want to take from the winners and give to the losers?" And the author said the tone was just shocking, like he'd suggested something truly terrible. And that one sentence changed everything. Suddenly, this wasn't a logical, math-based strategy. No, now it was Robin Hood investing. And that just sounded wrong. And boom, just like that, the idea was shot down. Dead on arrival. The analyst tried to reason with him, explaining, hey, these are all winners we picked. We're just managing the ups and downs. But it was no use.
That gut reaction, that emotional response to taking from winners and giving to losers, it was just too strong. Logic stood no chance against that kind of instinct. But wait, the story isn't over. Not by a long shot. Years go by, and our analyst is thinking back on that day, and he has this sudden, startling realization. His original analysis, the one he was so sure about, it actually had a huge flaw. And that flaw has a name: survivorship bias. It's a classic trap in statistics. It's where you only look at the things that survived. You know, the companies still in business, the funds that didn't go bust, or, in this case, the managers who were still active. You totally ignore all the ones that failed along the way. And doing that, well, it can make your results look way, way better than they actually are. So here's the kicker. His first test only used a database of active managers. It didn't have any of the managers who did so badly, they just disappeared. This raised a massive question. When he was giving to the losers, was he actually just throwing good money after bad? Was he propping up managers who were doomed to fail anyway? His original test had no way of answering that. So to get a real, honest answer, he had to design a new test, a much tougher one. This time, he got his hands on a complete database, one that had both the active managers and all the ones who had gone out of business. This totally got rid of that survivorship bias problem. Then he set up 10 random portfolios and ran a simulation over 5 years, comparing a simple buy and hold approach against his monthly rebalancing idea. All right, so this is the moment of truth. Did the Robinhood idea actually work when you put it through this much tougher, unbiased test? Or was his boss right all along? Let's dig into the evidence. Okay, so this table breaks it down. It shows how the portfolios ranked compared to the individual managers inside them. Now, if you look at just the pure return, the rank was pretty much a wash. But check out the columns for risk, and especially the overall return to risk ratio. The rebalanced portfolios consistently got better ranks, which means they were less risky. On average, they ranked 2.7 for return/risk, while the hands-off portfolios ranked 3.2. The takeaway here is crystal clear. Rebalancing systematically lowered the risk. And here's the big number, the headline. When you boil it all down, the portfolios that got rebalanced every single month had an 18% higher return-to-risk ratio on average. Think about that. In 8 out of the 10 different tests, rebalancing gave a better risk-adjusted result. And that's even counting all the managers who failed. Okay, now this is where it gets really interesting. On its own, just rebalancing gave you a higher pure return about half the time. A coin flip, basically. But the key is, it almost always lowered your risk. So what if you use that extra safety to juice your returns a bit? By adding just a little bit of leverage, say 10%, which is basically borrowing a little to invest more, the results they flip completely. The rebalanced portfolio now beats the old strategy 80% of the time, just on pure return. That's a huge difference. So, the new data is undeniable. The strategy works. It clearly improves your risk-adjusted returns, which brings us back to the big question. Why did the boss have such a gut-wrenching reaction to it? And why isn't everyone doing this? Well, the answer isn't in the math. It's in our heads. So why does it work? Mechanically, it's just beautiful and simple. Rebalancing automatically forces you to do the one thing every investor says they want to do: sell high and buy low. Think about it. When a manager has a killer month, their slice of the pie gets bigger. Rebalancing makes you take some of those winnings off the table. And when a manager has a rough month, their slice shrinks. Rebalancing makes you buy more when it's down. It's like having automated discipline built right in. And this really gets to the heart of the mental battle. Our gut, our instinct, tells us to chase performance, right? Find the person who's hot and give them more money. But the data? The data says that as long as a manager is good enough to have in your lineup in the first place, doing the exact opposite is almost always the better strategy, mathematically speaking. And that brings us right back around to that boss's reaction. The real reason this powerful method is usually just ignored, it's just plain old human nature. Moving money away from the person who just made you a bunch of it and giving it to the person who just lost you some, it just feels so wrong. It goes against everything we think we know about rewarding success and punishing failure. So that leaves us with one last thing to think about. This whole Robinhood investing story, it's not just about managing a portfolio. It's a fantastic case study of the constant fight between evidence and emotion. And it really forces us to look in the mirror and ask ourselves a tough question.
Are our own investment decisions based on actual evidence, or are we just doing what feels comfortable? All right, today we're going to tackle a huge investing myth, one that most of us take for granted, that high volatility is always a bad thing. But what if I told you that a so-called risky asset, one that bounces all over the place, could actually make your entire portfolio safer? Sounds crazy, right? Well, let's dive in and bust this myth wide open. Okay, let me ask you something. Let's say you've got two funds in front of you. They have the exact same average return. In fact, they're pretty much identical in every way. But there's one little catch, one key difference: their volatility, how much their price swings up and down. Now, I'm willing to bet that 9 out of 10 people, heck, maybe 10 out of 10, would immediately jump on Fund A, the one with low volatility. It just feels safer, right? It's the stable, steady choice, and that seems totally reasonable. But what if I told you that gut instinct, that common wisdom, might be completely wrong? This all started with a fascinating real-world story. So where does this crazy idea even come from? Well, it all starts with a story. A simple conversation between two fund managers that really flips everything we think we know about risk on its head. Picture this. A couple of fund managers are chatting. One of them had just checked out a pretty promising local fund, and he asks the other guy, "Hey, what do you think of them?" Now, the second manager knows the team really well. He'd even worked with one of their guys for over a decade, said he was brilliant. But then, when asked if he put his own money in their fund, his answer was a flat no. So of course, the next question is, why on earth not? And that's when he drops it. The entire reason boiled down to one single number, a Sharpe ratio of about 0.4. To him, that was the end of the story, a deal breaker. And, on the surface, that sounds super smart, right? It's a hard number, a data-driven decision. But what does it actually mean? So what the heck is a Sharpe ratio? Well, it's a super common metric investors use. And the most important thing to get here is that the formula specifically dings an investment for having high volatility. A bigger Sharpe ratio is supposed to be better. It means you're getting more bang for your buck, more return for the risk you're taking. So a low number, like 0.4, looked like a big red flag. Okay, but here is the twist. This is the fundamental flaw in that manager's thinking. He was making a classic mistake. He was looking at this one fund in a vacuum. He was looking at one tree and completely missing the forest. You can't just judge an investment on its own. You have to see how it fits in with your entire portfolio. And that brings us to the secret ingredient that flips this whole thing upside down. It's a powerful concept called correlation, or, to be more precise, inverse correlation. It's a really cool idea, and it's simpler than it sounds. Inverse correlation just means when one thing zigs, the other thing zags. So when the rest of your portfolio is taking a nosedive, this asset tends to go up. It's like a built-in shock absorber for your portfolio, cushioning the blows when things get rough. Okay, now hang on, because this is where your brain might start to hurt a little, in a good way. For an asset that zags when everything all zigs, that high volatility we're all so scared of can actually be your best friend. Why? Because it means when it zags up, it might zag up in a huge way right when you need it the most, erasing losses from your other investments. I know, that sounds completely backwards. So don't just take my word for it. Let's put this to the test and look at the actual numbers from the source material. We're going to check out a hypothetical fund and see how this all plays out in the real world. So to really dig into this, the source material cooked up a little experiment. They created two versions of a fund, one with low volatility, one with high volatility. The key thing is they both have the exact same average monthly return. First up, let's see how they look when they're all by themselves. Okay, so take a look at this. When you look at these funds in isolation, the choice seems like a total no-brainer, right? I mean, look at that high volatility column. The compounded return is only 2.93%, way less than the low volatility one. And its standard deviation, that volatility measure, is a whopping 23.81%. It just looks terrible from every angle. And this chart just drives the point home. I mean, look at that. The return you get for the risk you take on the low volatility fund is way up here at 0.95. And the high volatility one, it's barely even on the chart, down at a tiny 0.12. It's almost 8 times worse. If you stopped right here, you'd throw the high volatility fund in the trash. But, and this is the big but, we can't stop there. We have to think from that portfolio perspective. So what happens when we take these funds, which
remember, are designed to be inversely correlated with the market, and we stick them inside a simple portfolio that's 80% S&P 500. And bam, look at this. The results just do a complete 180. The portfolio with our supposedly inferior high volatility fund is suddenly the star player. Everything we thought we knew is now completely upside down. The game is totally changed.
Let's really chew on this, because this is the big aha moment. The portfolio that used that terrible high volatility fund actually ends up with a higher compounded return at 2.18%. And get this is the really wild part. It does it with less overall risk, a lower standard deviation of just 11.45%. More return, less risk. How is that possible? So what just happened here? Well, that huge negative drag from volatility that we saw before, poof, at the portfolio level, it's gone. It completely disappeared. That magical inverse correlation, that zagging effect, took what looked like a massive weakness and turned it into an incredible strength. So what does this all mean for you? It means we gotta throw out some of the old, dusty rules of thumb we have about risk. It's time to bust a couple of very common and very costly misconceptions. All right, first up, let's bust misconception number 49, the idea that lower volatility is always better. The reality, well, yeah, usually it is, but the moment you find something that's inversely correlated to your portfolio, that rule goes right out the window. High volatility could be totally fine, or like we just saw, it could actually be a huge benefit. And that brings us to the next big one, misconception number 50. That a higher return to volatility ratio, like the Sharpe ratio, is always the goal. The truth is that ratio can be incredibly misleading for individual assets that sag. That number only tells you the real story when you're looking at the whole enchilada, your entire combined portfolio. So, practically speaking, what should you do with this information? When you're looking at a new investment, there are two things you absolutely have to do. Step one, yes, of course, you have to look at the fund by itself. Is it run by smart people? Does it have a good process? But step two, and you cannot skip this, is you have to analyze how it's going to play with all the other investments in your portfolio's sandbox. If there's just one thing you take away from all of this, let it be this simple but incredibly powerful idea. It's the ultimate team sport view of investing. The whole is truly different, and often much greater, than the sum of its parts. So I'll leave you with this to think about. Armed with this new way of looking at risk, what asset is out there that you've always dismissed as too volatile or too risky? Could that actually be the secret ingredient to making your entire portfolio stronger and, believe it or not, safer? Thanks for tuning in.
All right, let's talk about the quest that every single investor is on, building that perfect investment portfolio. You know, one that's smart, resilient, and, of course, grows our wealth. But in a world with just an infinite number of choices, how in the world do we find that optimal mix?
It's a really tempting thought, isn't it? So many of us are looking for a simple, automated solution to what is a super complex problem. You know, a single button we can push that just figures it all out for us.
And this is where something called portfolio optimization comes into play. It really seems like that magic button we've all been looking for. It's software that crunches historical data and then promises to deliver the perfect mathematically derived allocation for your investments. A scientific push-button solution. Sounds great, right?
In this chart right here, this is its promise visualized. It's called the efficient frontier, and it basically promises to find the perfect balance between risk and return. The whole idea is simple. You pick your risk level, and the software points to the exact spot on this curve that will supposedly get you the highest possible return. I mean, it looks foolproof, it looks scientific, but is it?
So in this explainer, we're going to dig into the illusion of optimization. We'll see exactly why the past fails to predict the future, and then we're going to build a much better framework with 8 sound principles. We'll also look at some smarter tools that go way beyond simple correlation, and then wrap it all up with the key takeaways for smarter investing.
The thing about optimization software is that it's just so appealing because it promises to remove all the guesswork, all the emotion, all the uncertainty from investing. It offers this world of mathematical precision.
So the dream is one of precision and simplicity. But the reality? Well, the reality is far more dangerous. This seemingly scientific method is built on deeply flawed assumptions that can lead to portfolios that underperform, especially right when you need them to work the most.
Okay, now, let's pull back the curtain and really look at the cracks in that foundation. Let's understand precisely why this so-called perfect tool can be so incredibly misleading.
It all boils down to two critical, and very often wrong, assumptions. The first is that past returns, volatilities, and correlations are a reliable guide for what's going to happen in the future. And the second is that an investment's historical volatility is an accurate way to measure its actual risk. Let me tell you, both of these ideas can fall apart spectacularly.
And look, this isn't just a theory. Think about it. In 1999, optimization software would have told you to load up on tech stocks, right before the bubble burst. Then in 2007, it would have pointed you straight towards assets exposed to credit and emerging markets, just before the global financial crisis. In both cases, the software was building a perfect portfolio for a world that no longer existed.
This quote just perfectly captures the core problem here. Portfolio optimization gives you a precise answer to the wrong question. It's literally optimizing for the past. What we need is a framework that helps us build a robust portfolio for the future, even if it feels a little less precise.
So, if that's the problem, what's the solution? Well, now we're going to shift to a reality-based approach, a blueprint built on 8 sound principles for constructing a truly resilient portfolio. These 8 core ideas, they're not some magic formula. Instead, they're a disciplined way of thinking that protects you from the very traps of portfolio optimization we just talked about. So, let's break them down. The first 3 principles are all about shifting your perspective. See, it's not enough to just chase high returns. You have to understand the risk you're taking to get them. It's also absolutely crucial to look beyond simple volatility and understand the real risks in an investment. And finally, you have to be able to tell the difference between a manager who is truly skilled and one who just got lucky in a rising market.
All right, the next 3 principles get into the real mechanics of building your portfolio. True diversification is about owning enough different assets to protect yourself against those worst-case scenarios. It's also about looking past broad category labels like stocks or bonds and focusing on how individual managers actually behave. That's a bottom-up approach. And central to that whole idea is understanding how your investments move in relation to each other.
Now, to really understand the 7th principle, which is one of the most important, let's look at the tale of 2 partners, Carol and Andrew. It's a powerful lesson in risk allocation.
So, Carol and Andrew, they co-manage a fund. They use the exact same trading system, but they have completely different philosophies. Carol is conservative. She wants to cut their risk in half to minimize any losses. Andrew, on the other hand, is aggressive. He wants to double down to maximize returns. They just can't agree, so they split up, and they each launch their own fund, using the identical system but at their own preferred risk levels. Okay, now here's the crucial point. Let's say you decided to invest in both of their funds. Should you give them equal amounts of money? Absolutely not. An equal dollar allocation to Andrew's aggressive fund would mean you're taking on 4 times the risk of the same allocation to Carol's conservative one. And this brings us right to Principle 7. The baseline for allocation shouldn't be equal assets, but equal risk. Higher risk strategies should get proportionally smaller allocations. Makes sense, right?
Truly understanding risk means you need the right tools. So let's go beyond the standard metrics and start asking the right questions, starting with a pretty common tool.
This is a standard correlation matrix. It's basically a grid that shows you how every investment in a portfolio moves in relationship to every other one. You see those shaded cells? They show you highly correlated pairs, assets that tend to move up and down together. It's a useful starting point for diversification.
But does correlation really answer the most important question for an investor? I mean, think about it. When the market is crashing, you're not sitting there asking about correlation. You're asking something much more urgent.
The question you really care about is this: what's the chance that my investments will all lose money at the same time? And for that, there's a much better tool, the Coincident Negative Return, or CNR matrix. Instead of measuring general correlation, it directly calculates the probability of simultaneous losses. This gives you a much more focused, practical way to measure true diversification during a downturn, which, let's be honest, is when it matters most.
So let's bring this all together. Our whole journey here has been about moving from some really common misconceptions to a more durable, reality-based way of thinking about building a portfolio.
So the core misconception is that optimization software is the answer. The reality? It's a false precision that can backfire badly. Another one is that diversifying by category is enough. But the reality is you have to look deeper, at individual managers.
And finally, this idea that good investments deserve equal dollar allocations is just flawed. The smarter reality is to allocate based on equal risk.
And this brings us to a final big question you should probably ask yourself. Are you chasing the illusion of mathematical certainty? Is your portfolio built on getting these incredibly precise answers to completely the wrong questions? Something to think about. Thanks for tuning in.